A very good morning. It's Thursday. You're watching India Market Open. It's been a turbulent ride for the last couple of days on D Street. And good morning, Niraj. We don't have much to hold on to in terms of global cues, but I guess even if we did, we seem to be dancing to our own tunes these days.
Yeah, you're wanting the week to end quickly, huh?
As quickly as possible, for more reasons than one.
More reasons than one, yes, indeed. But interesting that you say that. And just so many stocks which have, Samina, I mean, we needed positive doses after what has been not a great earnings season thus far. I think overnight, the set of numbers which have delivered better numbers versus the set of numbers that have delivered a wobble is much higher. Not too many index names, yes. But I think a lot of optimism out there, some positive news flow around a couple of companies like Paytm, Gujarat Fluorochem, we'll talk about all of them. I think there is optimism. Let's wait and watch how this shapes up though.
I like how you say there is optimism, and the markets at this stage are not feeling that. It's been a very tough ride. The Nifty is off 7% from its recent highs, and a lot of the pain has come in the last two trading days. Pardon me, actually it is Wednesday. I am in a rush to get the weekend in the last two trading days. Well, let's do a quick check of what's happening on the implied, take you through what's happening globally, and then of course set up trade for you as we always do. It's flat. So you've had a tough ride. Yesterday we were questioning whether 24,700 would have held out, but it did not hold out. And this morning, of course, the picture is still looking very bleak. Could be a morning of consolidation. Globally, we don't have much to hang on to. US equity markets have spent about 2 days consolidating. So yesterday as well, an overnight trade. There was nothing much that happened in terms of Wall Street trade. It was flat. So the Dow, the Nasdaq and the S&P 500 have gone home flat. The breadth of the market wasn't too bad over there either. You had a bunch of earnings that came out on Wall Street, and most of them, from what we understand, have beaten street expectations, and that's kept the bulls slightly excited. But you know what's worrying, and I think, Niraj, you might want to come in on this one, is what's happening to the 10-year in the US. I don't know what that market is thinking, and traders, I think, at this point are assessing what the outlook is. Because your 10-year spiking up is an indication that the economy is doing better than expected, and you may potentially not get this sort of aggressive rate cutting cycle. And if that happens, that's not good for risk on trade. So with bond yields at a 3.5-4 month high, not easing off, equities cooling off, is something that I might be a little concerned about. But for now, there's nothing for us to worry, at least for US equity markets. But I don't know if this is telling us a story that we might see unravel in the next few days.
Yeah, and maybe therefore it ties in with, or not ties in really, but the fear was, right, that if the Fed were to do another 50, which is very unlikely now, the pressure it puts on Reserve Bank of India to act. And if the Fed doesn't, which is very likely now, then it eases that pressure, right? External pressure that, oh, what's happening? Because the RBI has been very, how do I say, assured of its stance that don't want to go out and cut rates aggressively because it might be a risk. Now, the external pressure might ease, which is great.
And you can't not, right? I mean, we spoke to Manish yesterday, and he said as much as we talk about decoupling, the fact is that we are still an export-driven economy. So you've got to keep that rate differential constructively in your mind. But the fact remains that 85% of the market in the US still believes that an aggressive rate cut is coming. The bond markets at this stage are not painting that picture, and that could be a little bit of confusion in the minds of traders who are probably not unwilling to take very aggressive long trades. Also, the big trigger for that market is going to be the impending US election outcome. So until there's clarity on that front, trading activity may be rather limited. Of course, either of the presidents are not going to have a big impact in terms of the long-term story of US equities, and we've seen that historically. So data-backed, while it may lead to some intermediate volatility, the long-term story doesn't usually get impacted by a president who's in power or a party that's in power. That's what we have on Wall Street. The bond yields is a standout story, not equities. Across Asia this morning, it's a rather muted session, so nothing really in terms of a handover from Asia is what we have. You have one data point coming out of those markets, and that's the Singapore inflation number. We don't track that too closely, but it's expected to come in at a level that's a record low from 2021. So inflation easing out in a rather small but very important economy, the financial capital for most in Asia is Singapore. So that's what we have for Asia, we have for Wall Street. Standout is also what's happening in everything but equity, like I said. So gold and silver, I mean, look at gold, silver and crude, right? Gold has hit a record high. So it continues to increase or go higher from levels of $2,700 per ounce. Gold this year is up 27%. So it's beaten or it performed as well as any risk-on equity market in the world. Pretty much outperforming the Nifty as well in this year's performance. Silver, which has been quiet, has again been pulling out some really sharp moves, right? Silver was up 3%. It trades at levels which were last seen in 2012. So a very sharp up move on silver. Gold also looking good. Crude gained 2%, maybe largely on back of the fact that, or rather gained on Monday, held out on Tuesday in more ways than one. So flattish on crude. Commentary from Saudi Aramco is that they are still optimistic that China's demand will pick up. They don't think that there should be too much in terms of supply cuts. And they also seem to be worried about what's happening geopolitically. So I think that's giving support to crude, maybe to some extent to gold as well. But I think treasury and gold usually move in tandem. So I'm not surprised that gold and silver are moving just like the way the 10-year has been.
Interesting. Okay. Now, just before Samina dwells into yesterday's trade, just one thing that you got to keep an eye out for is news flow emanating from Russia. And that is something that is vital importance because Prime Minister Modi and Xi Jinping are slated to meet today. There is a meeting, of course, that will happen, or multiple meetings that could happen between Russian officials and Indian officials as well, PM Modi and Vladimir Putin. But after the de-escalation at the LAC, sound bites emanating from Prime Minister Modi and Xi Jinping's meeting would assume vital significance because I think almost all participants agreed unanimously that this is a big shot in the arm if China and India decide to de-escalate. Since that has happened, and now if there are positive sound bites, I'm really looking forward to that.
Yeah, there'll be hopefully some good news coming in from that quarters of the world. So globally, that's what we have. Implied Nifty is indicating to a flat start, like I said, and Niraj will tell us what we should be looking for in trade today. But I'll quickly recap what happened yesterday. It was a very tough day. We didn't go into the markets anticipating a big correction. The expectation was that at least 24,700 would have been held out. But from the way you see it, you had a 310 points slump on the Nifty. It was very turbulent, 1.25% getting wiped out. Now, while the Nifty looks painful, the fact remains the true pain and trauma was felt in the broader markets that sold off very sharply. There are stocks that have actually halved in the last couple of months of trade. What we did see is that the Nifty, while gave up 1.2% yesterday, it's actually down 7% from the record high it made in the month of September. The mid-cap is where the pain was. Mid-cap is also down sharply. It's down 7% as well from its peak, but 5% of that cut has come in the last 2 days of trade. So while we've been debating that is this going to be a long-drawn correction, consolidation, is it going to be sharp and painful? From the way it's looking, it's sharp and painful for anything and everything in the broader market universe. Small-cap stocks have held out until yesterday, but yesterday, of course, they took it to the chin as well. Small cap index corrected 4% in trade. I think barring Dr. Lal Path Labs, every stock in the small cap universe ended lower. PSU banks was a pain point. It was the worst performing sector in trade, down 4%. Real estate and metals dropped 3% as well for no major reason. It was literally profit-taking, FI selling to add to that earnings disappointment maybe is what we had. 13 lakh crore of investor wealth has been wiped out in the last 2 trading days. So if your portfolios are looking bad, you are not alone in this. All portfolios are probably being hit quite badly over the last few days. Of the 50 Nifty stocks, 48 stocks ended in lower territory. What also was a big surprise was how the Hyundai IPO was greeted. While I know we weren't very excited about this one because it was priced to perfection, but going home with a cut of 7% wasn't probably what made the promoters or the founders or investors happy in trade yesterday. FIs continue to remain net sellers. They've sold every single day in the month of October. Their selling has now extended to over $10 billion. A little bit of buying was seen yesterday from domestic institutions. Remember that portfolios are sitting on some cash, right? We've talked to fund managers over the last few months, and they've all talked about how they have some dry powder available, which also means that they're beginning to allocate gradually, upfronting into the markets on spotting opportunities. So DI has bought about 5,800 odd crores. FIs continue to sell. I mean, the pain is on the screen. I don't think there's anything more I can add that could be even marginally positive, but I think you have a little bit of good news in terms of what a commentary was from managements.
Yeah, I mean, Samina, yesterday, a clutch of management commentaries looked fairly positive. So our research team attended some of the con calls. There are people in the market which spoke about some of the con calls, including SRF, for example. The con call was pretty strong too. Or the belief around H2 was good. Supreme Industries cut the volume growth guidance to 16 to 18%. The commentary around H2 was very good. Kajaria mentioned that 2H
focusing on the broader market universe.
Yeah, I mean, as of now, those are the con calls that happened, right? So as Cement too, I think the con calls that came in all spoke about some optimism. So we know that Q1 was disrupted, or elections and rainfall, excess rainfall have disrupted things. Can things turn? And I mean, no relevance to whether this is not connected to what the valuations in the market are. But I'm just saying that there's so much of despair yesterday. Every single stock was beaten down 5% when it came out with numbers. The slightest miss was punished. I'm just saying that the con calls look slightly more positive than what the mood on the street did yesterday. So that's the small point. Saving grace. Exactly. So the technical setup, viewers, wobbly. Key support lines are broken. Very difficult for a chartist to tell you that things will not look weaker because, as Samina has been saying, 24, 750, 700, key support line, just taken our knife through butter. But quant indicators suggesting a reversal around the corner. Con calls of various companies indicate an uptick in H2. And yesterday, a lot of HNI investors, I've been told, don't call every investor a smart investor. They just give gyan. They're not beating the benchmark, be that as it may. I'm saying people who've traditionally beaten the markets and are perceived to be smart are all nibbling into some of the beaten down pockets, particularly financials. So that might be interesting. And Samina, the IPO subscription. I mean, you are a better judge of that, but Worry, Deepak Builders, strong subscription numbers there.
Yeah, I think something to look forward to. But just talking about how beaten down things were on the Nifty 500 yesterday, 485 stocks have ended lower. You only had 15 stocks. I mean, that's not even 10% of the market or 10% of the Nifty 500 universe that ended in the green. And Niraj, while we talk about how counters are getting punished when there's a slight miss, counters are getting punished even if there is no slight miss. So even if you meet in street expectations, there are stocks that have sold off very, very sharply for no apparent reason. And just beyond earnings, look at the news we had on Ambuja and Orient yesterday. This largely is considered a positive. It may not be an interim positive, maybe the valuation, maybe the fact that acquisitions are happening too aggressively, but I think everyone we spoke to, the consensus, it's a big positive for Ambuja. It's also good for Orient Cement investors. Both those counters started off the day strong, went home with cuts. So I don't think the news flow has anything to do with stock performance at this stage, but we can hope for the best, and that's what we're going to do. We're going to hope that there's a little bit of support in the markets today. There's a little bit of recovery. What are we watching out for, Niraj? 24,400 holds out today, and there's so many earnings to react to as well, and some of them are actually pretty good. Yeah.
So, I mean, Samina, I'll start the list, but just very interesting, Samina, that, I mean, aside of earnings news flow, with a Gujarat Fluoro, Paytm, and a lot of others, there is positive news flow otherwise as well. So looking forward to that entire list. Niraj is trying really hard to sound as positive as he can. Good results as well today. I mean, there are lots of good results actually. Sorry, what I mean is a lot of very important companies coming at the results today, right? That too. Godrej Properties, United Spirits, TVS Motors after Bajaj Auto's horror show, if you will. Important to see what TVS Motors has to say. Yeah, you've got lots of earnings, but I'll quickly highlight the IPO which Niraj just talked about. Vari Energies. I mean, this is one of those few exciting IPOs that hit the street after many weeks.
And the numbers are there to tell, right? It is 10 times the size of Premier Energies, which is trading at a huge premium. Vari came in at a discount, so market participants were very excited about it. Some very significant marquee hands have put money in it. And on day 2, which was yesterday, the oversubscription was 8.5 times. I mean, just compare it to a Hyundai, which on the last day finally managed to pull out 2x in terms of oversubscription. Deepak Builders is small, and hence the subscription number, the oversubscription number looks larger. 12x is what it was oversubscribed by. So retailers very excited for these two subscriptions. The listing will happen on the 28th of October, so we'll wait until then. But a good chance that Vari will list at double the price of its subscription. Apart from that, let's go into stocks. Markets today will also be very closely watching out for the Nifty Bank weekly expiry. Yesterday was tough. We didn't think 51,600, 51,500 would get breached. We've headed all the way down to 51,257. There were a couple of buy calls where technical analysts believe that 51,400 could act as a support and the Nifty Bank would bounce. It didn't happen yesterday, but today there is some hope that you may see a little bit of bottoming out on Nifty Bank if PSU banks give the much needed support to it. Apart from that, we'll react to earnings of Bajaj Finance, Amber Enterprise, Canfin Homes, ICICI Pru, M&M Finance, Max Financial, Persistent, Coforge, Zomato, amongst many others. I'll highlight a few earnings, and of course then Niraj will take over what he's got on his list. Bajaj Finance reporting, commentary was positive. Numbers were largely in line with what the street was expecting. Revenues were up 28%. Net profit was up 13%. Net interest income also has seen a pretty good jump of 23% to come in at 8,800 crores. AUM stands at 29%. Net NP is at 0.4, so not too bad in that sense. Credit card guidance has been hiked from 1.75 to 1.85. They've marginally increased that to 2 to 2.05. There was an exceptional gain item which resulted in the numbers probably looking better. If you look at operational performance, it may not look as healthy, but because of that exceptional gain, it actually looks like a good number to see on back of the Bajaj Housing stake sale. So largely in line numbers. Credit cost was a little bit of a dampener, but the management has indicated that that could be topping out now. So we could be turning the corner in terms of credit cost for companies like Bajaj Finance. Worst is behind them, and that's what you'll be taking hope from. So I think the numbers largely in line, commentary positive, stock should get a little bit of a thumbs up, but who's to tell what the sentiment of the street is. The other one that we've talked about extensively, and we there's so much to talk about on this one, right? And that is Zomato. Numbers on the face of it were a clear beat. Revenue is up 68%, EBITDA at 226, EBITDA margins at 4.7, but adjusted EBITDA is still negative. Niraj, I don't know if you want to comment on this, at 8 crores. And I think this is what stood out, right? Margin improvement is still struggling. Dipinder Goel has talked about the fact that the reason that's happening is because they're spending a lot of money in expansion. They're not only adding dark stores, which has impacted the numbers significantly, they're adding their warehouse capacity. And of course, in 4 weeks, you're going to have district that launches. So all of this is big cash burn, right? A few weeks ago, we told you about the fact that they're looking to do an aggressive fundraise of 8,500 crores. That has been confirmed. This is what may lead to some shareholder wealth destruction because they're already sitting on 10,000 crores of cash. They have a significant quantum, which is 10% of their revenue sitting on treasury income. So while the plan is in place, this is an expensive stock and shareholders are not getting rewarded. Active fundraising, treasury, which is probably compensating a little bit of the dip at the bottom line. So all those things, interim jerks, but I still think Zomato is a proxy to Swiggy for retail investors. It's a duopoly. So while it's expensive, yes, but the fact still remains that that is a story, and that is a story you're betting on.
Yeah, I thought the Citi note was interesting, Samina. I mean, and we have graphics for the same as well, but Citi is saying that they are seeing rising, they thought in the con call that there was some alluding to the rising competitive intensity and may not be massive discounts from Blinkit on the quick commerce side, but there could be an issue there, and they are factoring in those in their analysis, but not dramatically. So they still believe that Zomato could clock in growth, but they are certainly factoring in what happens as a result of the rising competitive intensity. In fact, Citi says that we take into consideration the somewhat increased risks in our profitability estimates. Let's see, I was talking to Rhythm Desai yesterday. He mentioned that the one sector where the competitive intensity is very high is not just because of the existing players, Blinkit, Swiggy, Zepto, but 4 or 5 other biggies want to enter the quick commerce space, and therefore that's a pocket.
Natural progression, you would imagine.
Yeah, so that's a pocket you want to be careful about.
It's so unfortunate because it's we saw the mom and pop stores, so the likes of a DMart getting impacted because of quick commerce, eating their share of the pie. Now we have quick commerce that is struggling because of its competitive intensity it's facing from its peers in the industry. And also the fact remains, and I think this is where I seem to get stuck. So while there is some concerns that growth may slow down, the good news is that Mr. Dipinder Goel is anticipating that and probably then raising those funds, because there will be a cash burn, right? If you have to deal with competition head on, I think the strategy for Zomato remains, and we'll understand more about it when we talk to an analyst, is to go out and do whatever it takes to, in order to build on your marketing spends, add dark stores, get your expansion in place, warehousing, availability of stock. All of those things will have to play out. The street may not seem too enthused when it opens up in trade, but we'll have to wait and see how that reaction is. Also, one more that I think Niraj and me have discussed extensively over the last few months, largely because of Vodafone, has been Indus Towers. Numbers look great, to say the least. Revenues are up, EBITDA is up, margins have improved from to 65.7 versus 48.45. Net profit is up 72%, but it's the Competition Commission that's approved the increase in shareholding of Bharti Airtel and Indus to 50%, 0.005. Now, I think this is good news for Vodafone because they will offload their stake to Bharti. It's good news for Bharti because they've got that much expected clearance, and definitely great news for Indus. So I think all three stocks, you would imagine positive impact, good numbers, and an approval on increase in shareholding. Yeah,
massive outperformance on the margins by Indus Towers.
Yeah. I don't even know if you want to tell our viewers, 1,727 times percent.
Basis points, right? So big uptick on the EBITDA margin front by Indus Towers, and therefore certainly you want to watch out for that.
This is operational. There's no one-offs from what I understand.
Yeah, because it's operational.
Right?
EBITDA, so therefore operational entirely. So very interesting. Okay, those are the top 3 on Samina's list, top 3 on my list, and then we'll maybe discuss 1 or 2 more. But Amber Enterprises, for a stock that's been as choppy as Amber has been, the numbers are very soothing. So it's up massively day before, was down about 10% yesterday. Now the numbers, revenues up 81% at 1685 crores versus 927 crores. The estimates were 1205 crores. Net profit, EBITDA, by the way, up 91% at 114 crores. The estimates was 84. Margin number, kind of okay. Slightly lower than anticipated, 20 basis points, but net profit at 21 crores versus a loss of 5.7 crores. The estimates were 4 crore profit. I think remarkable performance by Amber, beat on all fronts. Very likely the stock could react. So watch out for this one. Watch out for GMDC. That's the other one, which came out with a very solid set of numbers. Revenues were up 54.9% at 593 crores versus 383 crores. The profit after tax, 71.4 crores versus 71.4% higher at 128 crores versus 74.6 crores for GMDC. Those numbers will come up on your screen in a minute. Revenue is up 54.9%, 593 crores. EBITDA margins did well, PAT up 71%. Very strong performance by GMDC as well. Very likely could react positively in the session today. So I will definitely watch out for this one too in trade as a positive set of numbers. You can't take your eyes off Adani Green, by the way, because revenues were up 38%, EBITDA margin at 72.2 versus 76.5, and net profit up 39% at 515 crores versus 371 crores. So again, a solid set of numbers. Like I said, a lot of solid set of numbers. And Samina, last one on my list. I mean, there are a clutch of them, but last one on my list, the first list is Persistent Systems. The problem that happens for companies which deliver quarter after quarter is that the estimates are very high.
Expectations,
But revenues up in this environment, revenues up 5.84%, 2897 crores. EBIT margin 14% versus 14%, so in line, but ahead of estimates, but equal to the previous quarter. And net profit up 6.2% at 325 crores. Delivered on almost all counts. Let's see if there is a positive reaction here.
I'm surprised you didn't mention Electra Greentech on your list.
Very good numbers, right?
Very, very solid numbers. I'll quickly take you through that. Profits as expected. They do this quarter on quarter, right? But we'll still take you through how great they've done. Up 156% to come in at 47 crores. Revenues jumped 71% to 523 crores. EBITDA has spiked over 100% to come in at 81 crores. So they've doubled on their EBITDA. So operationally as well, great performance being pulled out by Electra Greentech. Margins have also seen an expansion, which is obvious, right? Because of the kind of EBITDA recording we've seen, have come in at 15.5 versus 13.2. I know this is an expensive stock. It's a very expensive stock as compared to its peers. And it, I think, looks even more expensive because its peers have sold off quite significantly in the last 1 month. Electra in the last 1 month hasn't done too badly. It's only down 3% despite being a expensive stock. But I guess the belief or the argument here is with the growth potential of this one, which some may believe justifies the kind of valuation the trade's at. It looks expensive as compared to the peers, but the numbers are phenomenal, to say the least. What was disappointing was what Shoppers Stop did, and I don't think we were very excited about this one, even ahead of numbers, but we'll take you through what they reported. Revenues were marginally up, single digit, 7%. EBITDA declined 7% at 150 crores. Margins have also dropped quite sharply. So this could be on back of maybe season's sales, getting rid of old stock. They also have significant competition now in the unlisted market in that sense at 13.4 versus 15.5. There's also a net loss of 20 crores that they've posted versus a profit of 2.7. So Shoppers Stop is going to have it rough this morning is what I'm pretty certain about. A quick update on Paytm, and I think this is the big story. A big positive reaction can be expected on 197 communication. The National Payments Corporation of India, which is NPCI, has finally granted the much anticipated approval to Paytm parent 197 Communications to onboard new UPI users. So they're back in business in terms of adding new customers.
Yeah, and Harsh is going to speak about that, but just watch out. Gujarat Fluoro, Reliance Infra, Sonata Software are some of the other names that you want to keep on your list for sure. But yeah.
I'll just quickly add two more. They're small, but they usually react to this. One is Rights. They won a big order for 55 crores. So after yesterday's trashing, there might be some recovery on this one on order wins. And Realtel as well has been recently bagging orders. 36 odd crores. The last time I bagged a 40 crore order, the stock was up 10%. Let's see if it responds well to this one. It's a 36 crore rupee order for Realtel. So Realtel and Rights could move on order wins, Niraj, this morning.
Yeah, let's go across to Harsh now because financials is the big sector that we're tracking in addition to IT, by the way, which will get a leg up because of Coforge and Persistent. But financials. And Harsh, over to you for what some of the results have looked like and the commentary more importantly.
Well, yes, I'll first start off with Bajaj Finance, and on the negative side, we are seeing elevated credit costs, and that seems to continue spill over in Q2 as well. Though Bajaj Finance believes the worst is now already factored. They've hiked their credit cost guidance 2% in Q1 FY25, 2.13% in Q2. They had guided for a band of 1.75 to 1.85 for FY25 full year. That looks unlikely now. They've therefore hiked their credit cost guidance to 2.05% for full year FY25. That's a substantial hike, a 20 basis point hike, 10% higher than what they had anticipated. Not looking good on that count. What's looking good though, cost of funds has peaked and therefore margins should therefore only get better from here. A rate cut, 25 basis points, should lead to a 12 basis points increase in margins, which is critical now. Not the full 25 because they're going more into secured products. They're changing strategy also a little bit. Change strategy likely to be announced in January of 2025. I'll switch over to M&M Financial because that's where you're also seeing some bit of pain. ROA guidance was 2.5% at the start of this financial year, was trimmed to 2.2% aspirational in Q1 FY25, now changed to 1.8 to 2%. Credit costs continue to rise for this one. What they were anticipating was a credit cost of almost 2%. In terms of where it goes from here, they're expecting H2 to be better, recoveries to start to kick in. They're focusing more on collections is what they're saying. They're investing also more on collections. They're tapering OPEX and therefore likely a 1.8 to 2% ROA is what they're guiding for. But they've sharply reduced it from the 2.5% aspiration at the start of this financial year. So that one will also be in focus. Stock has already been under some bit of pressure. Asset quality problems across the board, whether you're talking about CVs, whether you're talking about personal loans. That's really the takeaway from here.
Okay. So M&M Financial, Bajaj Finance, Harsh, credit cost peaking out is... So therefore, Harsh, very quickly, before we get to Paytm, just one quick thing. I mean, most notes that I read seem to suggest, Morgan Stanley, for example, is saying that this is the bottom for Bajaj Finance. MK seem to believe that credit costs are peaking and therefore things will turn even if there's a lower target price. Because the current price is also not like 8,000 odd. So could it happen that the street will look at that and therefore the stock may actually do slightly better?
That's a great observation, Niraj. In fact, I missed saying that. So the EPS trim by some of these analysts are just maybe 1 to 3 or 4%. So it's not a very large trim on the EPS count. Also, they believe that valuations are starting to look attractive because the stock hasn't performed at all. You're looking at 6,700 on a roughly 12 to 1,300 crore book value. 12 to 1,300 rupee book value, and therefore your valuations are at likely all-time lows. Never seen Bajaj Finance trade at 5 times price to book, and therefore they are starting to see possibly a very solid upside from here. For example, Morgan Stanley's target price of 9,000 is a 35% upside from here. So some of these brokerages really keeping or holding on to their target prices while trimming EPS by just a wee bit. Even Citi's target price is roughly 8,200. So good strong upside from here is what they are factoring in. Likely a positive reaction just on the basis of the underperformance on the stock, but that doesn't take away from what the commentary seems to be suggesting.
Okay, Harsh, and what about Paytm? Samina mentioned the news, but what will this mean for Paytm?
Well, Niraj, all this time, what Paytm has been doing for its users is they've only been able to use their wallets. Now UPI comes on stream, which is a big positive. This will, of course, lead to more transactions on the platform itself. So, and mind you, Paytm attracts customers because it can offer payments. That's its primary attraction to customers, and therefore, customers likely to get or use the Paytm app far more, given that UPI is now available. Of course, I have to wait and watch for trends as to how that plays out over the next maybe 2 quarters. But at least what MK and Bernstein, the 2 brokerage notes that I have read since morning, seem to be suggesting is that they are constructive with regard to monthly transacting users, and more users on the platform means more business for Paytm, even in other products. So likely a positive reaction on Paytm on the back of this. It's really constructive. One, more users on the platform, more people adopting Paytm because UPI is available. Second, you'll have more users looking at more products and therefore revenue will get better. So monthly transacting users as well as revenue likely positive. Whether it's bottomed, I'm not so sure in terms of stock price, but what in terms of numbers, in terms of quarterly numbers, whether the numbers have bottomed or not, likely is what most analysts on the street are saying. So that's another positive.
Thanks for that, Harsh. There are a bunch of positives on Paytm. The stock, for sure, certain, should be reacting positively. But it's not just Paytm, relief on Paytm. It's also Gujarat Fluoro. Niraj, you want to highlight the story that you've been talking about? Yeah. Because it stands out from what you told me.
Yeah, I mean, ideally it should stand out. Maybe first let's go to Varsha, Samina, because I think she's got the details of the development that has happened. Varsha, tell us, why is Gujarat Fluorochem in focus today?
Well, thanks Niraj for that. So Gujarat Fluorochemicals subsidiary company, which is a GFCL EV, is going to raise 1,000 crore at 25,000 crore valuation that they've given. Now fundraise will be led by Inox GFL promoters and key investors. Now this fund will support capex in EV and ESS sector. Now what are the key products that they're going to sell is, one is electrolyte salts, cathode materials and binders. Now all these chemicals are used to make lithium ion batteries. Now already company is into these products, but they're gonna expand at a huge scale. Now, if I were to speak about the capex plan that company has been highlighting in their con calls, they're going to invest around 6,000 crores over the next 4 to 5 years, out of which 2,400 crore capex will be done over next 2 years, and they're aiming 2x asset turnover at 25% EBITDA margin. Now, already they are in talks with the global customers for this EV battery chemical business, and they're engaging with 20 plus global EV customers, and revenues are expected from second half of FY25. If I were to talk about the market outlook, EV battery market is expected to reach at $300 billion by 2030, and lithium battery demand is projected to grow 5 to 6x by 2030. Now, just a rough calculation, if they were to do 2,400 of capex in the next 2 years, so assuming by FY27 or 28, they're going to do almost 4,800 crores of revenue when it comes to EV chemical battery business. So at a 25% EBITDA margin, they will have an EBITDA of around 1,200 crore only from the EV business.
Well, certainly watch out for this one, Varsha. So thanks for putting this into perspective. Samina, interesting, right? 50,000 crores market cap. EV subsidiary valuation in the current times at 25,000 crores.
And they've raised?
Yeah, they're raising 1,000 crores.
And we don't know who's giving them the 1,000 crores, so we don't know which investors have come on board just yet.
Yeah, for sure, I don't know if she's still there. I don't think the names of the investors are out as yet, but be that as it may, the point being that for us, for a business which isn't contributing majorly to that business, valued at 25,000 crores, should be construed positively. I would reckon the stock could react. So let's wait and watch. Okay. Focus on the derivative space, and as is the case, Agam Vakil is standing by for his call on this. And Agam, how are you observing the pocket today, and what strategies for us today?
Right, well, tough markets right now, and while the benchmarks have come off around 1.25%, we're also looking at deep cashes in the broader markets. It's going to be one of those days where I reckon that a lot of traders will have to grapple with the current data in the kind of traction that we're seeing. But I'm going to very quickly take you through what's happened yesterday. So 1.25% decline for the Nifty. It's seen a little bit of an increase in open interest when it comes to the futures. The Bank Nifty is again where we are seeing a little bit of weakness coming in. Well, decline of around 1.4%, about 3.4% added in open interest towards shorts. Moving on to the options market. Naturally, we did see a lot more writing in terms of calls yesterday, even as the Nifty weakened significantly. And it does seem like at the moment, 24,500 is becoming a little bit of an important level, because not only are we seeing a lot of those puts which were earlier written unwind yesterday, but the 50 daily moving average is just a mark short of the 24,500 level, so which means that strike becomes important. But as you can see, maximum open interest for puts has shifted to all the way down to 24,000. Moving on to the Bank Nifty, again, it's been a tricky index, but again, because of the weakness that we saw yesterday, a lot more call writing coming through in comparison to puts being written. Moving on to the stocks, well, a lot more losers yesterday. We had a very, very weak market breadth, not only on the benchmarks, but also in the broader markets. Tata Chemicals looking at shorts once again, Ipca Labs, Bajaj Auto, Dr. Lal Path Labs, all of them looking at significant amount of weakness. City Union Bank as an exception, moving up 12% and seeing longs. But on the other hand, in terms of stocks, we're seeing unwinding, a lot of long unwinding coming in for Balrampur Chini, Tata Communications, Oberoi Realty, as well as NTPC. So, the structure isn't looking very good, but let's take this conversation forward and see whether or not there are opportunities that you can take advantage of in these markets. We have Avni Bhatt of GM Financial, who joins us on the show this morning. Avni Bhatt, good morning, and thank you so much for joining in. What's the first stock on your radar, and what kind of an option structure that you're deploying here?
Good morning, Adam, and a very good morning to all the viewers as well. A slight view on Nifty first. So Nifty is in a very oversold zone. RSI is in an oversold zone. OIPCR overall has come down to 0.73, and for the weekly expiry tomorrow, it has come down to 0.5. So again, very oversold. So I think some bit of, if at all we see some gap down opening today, or maybe another 100 to 150 points correction on Nifty, post that there is a possibility of a dead cat bounce. that could take Nifty right up to around 24,600 to 650 levels. So, assuming that this dead cat bounce plays out, the stocks that have held on to their grounds and not really corrected much from the top, one of those stocks is Bharti Airtel. So the view is mildly bullish in this case, and that's why we go for a ratio call ratio spread in this particular stock, wherein we buy one lot of October 1700 call. It closed at around 23 yesterday, and we sell two lots of 1740 call at around 10 rupees. So the view is that the stock would recover up to around 720 to 1725, but it will not cross 1740 level. And given that the number of days to expiry is very short, I think going for a plain vanilla call would be dangerous. The time value will depreciate very fast. So we are offsetting that by selling two lots of 1740. We are balancing out the theta component over here. And the maximum profit would be anywhere between 1720 to 1740. And safely, for the sake of simplicity, I've kept the target as anywhere between 14,000 to 16,000. Once you see that kind of profit, you can book out. And the maximum loss is fixed in this case. Anywhere if the stock goes down, the maximum loss is going to be 3 rupees. So in this kind of market, I think it's better to stick to stocks wherein you have to bother only about your own direction and not bother about if at all the view does not play out and it goes down, then at least you are not bothered about incremental losses in this case, because your loss is fixed and that's a very minimal loss, just 3 points. So that's the strategy for Bharti Airtel. I have one more stock on radar, which is on the short side. That is Coal India. Coal India has given a fresh breakdown below the weekly support level of 475 yesterday. And with meaningful open interest addition on the short side in futures. So we are expecting the stock to further go down to around 455 levels. And in this case, we again go for a bear spread. We are not going for vanilla options because of the time value factor.
No point.
We buy 470 put and we sell 460 put at a difference of 4 rupees. Maximum profit in this case is around rupees 12,000, and you can keep a stop loss of rupees 6,600.
Avni, I just have a follow-up question on your first strategy when it comes to Bharti Airtel. You know, at the small chance, the very small chance that the Bharti Airtel in fact does go ahead and hits 1740, under those circumstances, because of the fact that we are selling two calls, there's always that possibility of a little bit of an extended loss out there. And I know the time value is pertinent here in this case, but what if we do see a very sharp spike, and under those circumstances, what is the break even at which you would want to once again potentially book out from that position if we do see a very sharp spike upwards as well?
So 1740 is the resistance as per the options data. There's a huge open interest built up at that level. So 1740 would be a trigger point. If at all it crosses that, only then we may see a further spike in the stock. But the expectation is it won't go beyond that. And in any case, in this particular strategy, the break even on the upside is 1777. So it's a difference between 1740 and 1700. That is 40 is the strike difference, plus the 1740 strike which you are selling. So that gives you 1780, and we are giving 3 rupees from our pocket. So that gives you a break even of 1777, which I do not think that it will be crossed in this particular expiry.
Thank you so much for joining us and taking us through those two ideas that we can deploy in these markets. Of course, if you do have queries with respect to F&O, don't forget to write to us on that number which is being flashed for you on your screen, and we'll be sure to take up your queries on the F&O show today at 10:30. But with that, it's back to you all.
Hi, thank you for that, I'm sorry. The market, of course, even Avni saying it's easy to stick with stock-specific actions as opposed to betting on the direction of the market, even though a part of me which still believes that there could be a little bit of a recovery that comes through today in trade, especially after the kind of fall that we've seen over the last 2 days, not just on the Nifty, but also in terms of Bank Nifty, PSU banks, real estate, metals, the whole host of the sectors were under pressure. One stock that's going to be on top recall this morning will be Zomato. Posted numbers that on the face of it were a clear beat to what the street was expecting, but a couple of things have stood out. The fact that they've gone out with an aggressive fundraising plans despite sitting on cash. Secondly, they also have a significant portion, which is 10% of the top line, is part of treasury income. All of those things does mean that shareholder value is probably going to see some erosion. Management also has talked about the fact that operational EBITDA has been lower because they're on an expansion spree. So what we are seeing is some amount of cash burn that could be taking place for Zomato. But the expert Gaurav Malhotra, ED of Axis Capital, now joins in to talk to us about what he makes of Zomato's earnings and the fact that they've gone out with an aggressive fundraising plan. Hi Gaurav, good morning. Thanks for joining in. I'll start with the most pertinent question. The company is looking to raise 10,000, is already sitting on 10,000 crores roughly. But they've announced a fundraise plan of 8,500 crores over the next couple of weeks and months. What is Mr. Goyal thinking? What is the plan of the company? Because if you already have so much of cash you're sitting on, why dilute stakeholder value in that sense, right? I mean, is there a cash burn we're anticipating? What is your reading?
See, this is more of a signaling issue in our view, right? You have their two major competitors, Swiggy raising around 5,000 crores of fresh money. Zepto has raised reasonable sum of money, and as media reports say, they are raising a little bit more. So I think this is more of a signaling issue. If you recall, this is a very InfoEdge-ish way of doing things, right? And InfoEdge is a owner in Zomato as well. That whenever you see that there could be some of chance of increased competition, you don't wait for that event to take place. You sort of beef up your balance sheet in case you have to use it. Not saying that they will have to use it, but this is more of a signaling issue in our view.
Okay. The question that comes to mind is whether this fundraise and the commentary more importantly, right? So are they linked to very high competitive intensity? I'm just trying to understand. There are 3 or 4 other biggies which are trying to get into quick commerce. We know that QC or Blinkit is the way forward or the big growth trigger for Zomato perceptibly. So if the heightened competitive intensity is going to be there in the quick commerce space, could it be a telecom of the 2000s wherein there are a lot of players, lot of growth opportunities, great for the consumer, maybe not as good for the business? How do you think about this?
See, the thing is, this is not so we don't think so that this is in anticipation of some major competitive intensity spiking up, right? I think so everyone understands, including the companies in the private market, unlisted companies, that right now, while investors even in the private space would be interested and excited on the quick commerce opportunity, but this is not the time of 2021, etc., when you would have gotten a lot of money for basically just buying GOV without any associated profitability or path to profitability. So we don't think that is what is going to happen. Even yesterday, the company said that it's not as if with this fundraise, their dark store expansion, which they have guided to say 1,000 by March 25, 2,000 by December 26, those get accelerated because any which ways, if you see, they are already sitting on more than 10,000 crores of cash. So it's not as if this will help them expand or accelerate it faster. Like I said, see, this is you have other players raising money. You also want to ensure and give a signal that, look, your balance sheet is actually the strongest amongst everyone. So everyone needs to be careful from a competitive trying to increase the competitive intensity perspective.
Gaurav, I just want to ask you this, and of course, if you have a view on this one, because what also stood out for me is while the numbers on the face of it look very healthy and promising, adjusted EBITDA in this segment is negative. It's about negative 8 crores of loss. Management has indicated that they are struggling with expanding margins. They're also on an expansion spree, not just with regard to dark stores, but also with increasing the warehousing capacity. Now, do you feel like this could be a concern for the next couple of quarters? Because this is an expensive stock, and I don't know how much will shareholders be willing to wait or pay that premium while the company is going through that expansion phase, which anyway should be in the price.
Yeah. See, so the way to think about it is that, the company is growing very rapidly, right? It's growing its GOV more than 100% year on year. The dark store numbers is in fact expanding. So if in this environment, right, they are managing to keep that margin at that break-even-ish level, which is that 0.1% adjusted EBITDA margin for quick commerce, I think so that's fine, right? I think so it's to be expected that when you are expanding so quickly, obviously the margins will take a little bit of a backseat. But having said that, it's not as if that expansion is leading to dilution in margins, which is where the concern would be. So these margins have remained pretty flattish over the last, say, at least from last quarter onward, the margins have remained flattish despite this big expansion. So I don't think so that is something to be worried about.
That they're sitting on 400 crores of treasury, and some may say that they are masking, their performance on back of course, how a lot of the treasury income is coming in, which may mean that operationally things are still tough.
See, anyway, this is a company wherein people, investors, us analysts are essentially looking at the EBITDA and the above EBITDA metrics, right? It's not as if this company is profitable and hence you are sort of valuing it on PE basis. So obviously the treasury income is a large component given the kind of cash which is on the books. But I don't think so that in itself is being looked upon, either positively or negatively from the perspective of valuing the business.
So, Gaurav, what is your view on hyper pure base? Can this have the potential to become the next Zomato actually?
See, this is obviously a business which is very fast growing, and we do feel that, it has certain synergies with the dark store potentially, right? Because the dark store can then become the way for Zomato to to give the restaurants what they require. So this is something which is a longer term opportunity. Obviously, the top line growth is very strong here, but right now the margins are not improving. So this is something which will take time to sort of evolve over a period of time.
Gaurav, very quick word on District, because that's the next best thing investors are betting on. Are you anticipating any roadblocks? Dipinder Goel has said that in the next 4 weeks they should roll out and have the play. It should be a plug and play model that they would be at. Are you anticipating anything that stands out for you that could probably create a resistance in these plans?
No, really don't think so. What we had actually seen when this whole news was announced of them acquiring Paytm's business is that there are a lot of synergies between the two businesses in terms of who the target audience is and what they are sort of offering in terms of events, experiences, etc. And obviously the company has shown very good execution in its history. Transitioning from a classified to food delivery to quick commerce. So we do expect that there should not be any major roadblocks in the execution and rollout of District.
Lastly, Gaurav, quick take on the call at the current price. What are you expecting and what is your target?
So our target is 319 rupees, which is around 25% upside from here. So we remain bullish on the business. I think so. All the operating metrics are going in the right direction. There is a large opportunity in quick commerce. It's relatively underpenetrated. And obviously, Zomato has shown very good execution.
We'll leave it at that. Thanks so much for joining in today and giving us your thoughts. Really appreciate your time. And that's the Axis Capital view on Zomato. It's the big development of yesterday, but a lot of other things to focus on. And let's do a bit of a rapid fire because it's 8:50 already. Kush Bora, Johnson on the technicals, on the fundamentals, Mayuresh Joshi. On the derivatives, Chandan Taparia. Gentlemen, all three of you, thanks so much for taking the time out and being with us. Kush, very quickly, let's nail it down. We are doing a bit of a rapid fire here. If the markets start off flattish today, is there a call on the Nifty or the Bank Nifty that you would give out?
Sure, Niraj. Nifty, we'll see during the day how the day sets up and progresses. Bank Nifty is setting up for a long trade because it's gone into oversold territories as per the PCR, which is 0.59 and thereabouts. So with a stop loss around 50,800 odd, you could trade for 51,800, 52,200 kind of levels. Nifty, as I said, we'll need to see as to how the day progresses.
So you're constructive on the Bank Nifty with a stop loss. Nifty, you are waiting and watching.
Absolutely, have been for a while. Continue to remain so on Bank Nifty.
Okay, thanks for being that brisk, Kush. Just the nature of the day today. Chandan, come to you and I'll request you to maybe again a rapid fire. How are you trading the Nifty or the Bank Nifty today?
So first start with Nifty. Good morning, everyone. So setup is negative. The index has been making lower top, lower bottom, and we have noticed that every small bounce is being sold and levels are drifting lower. Index is holding well below its 50-day exponential moving average. So till the immediate level is not surpassed, I'll be with the short-term trend. Until Nifty remains below 24,650, I'll look for a downside move towards 24,200. In Bank Nifty, the momentum is getting hold, upside is being kept. However, multiple supports are there at 51,000. But bounce could be sold with hurdle of 51,600 for 51,000. So weakness may persist in both the indices as of now, looking at the market selling intensifying.
Mayuresh, how are you feeling? 7% lower from record highs. Are you buying the Nifty passively through an ETF?
Morning, Samina. Morning, Niraj. Morning, Kush. Morning, Chandan. So I think we are waiting out for the markets to settle down on its own. So we're not trying to rush in. But I completely agree with Kush and Chandan as well. Even our technical team feels that a bounce back is around the corner. Banks have surprisingly given good set of numbers, barring a few. So I think banks should perform well within the two indices.
So in light of this, what are the stock calls for the morning? Kush, can I come to you first? What are the stocks that you're trading today?
Sure. It's not a bad idea to start nibbling at some of the stocks that you've wanted and, are perhaps seeing some cool off. This is a market where you'd want to perhaps do that. So I've got a long and a short idea both. On the long side, we've got Poly Medicure. Now, this stock has had a good run. It's just about to complete that rounding, bottom formation and, could see a breakout from there. So slightly preemptive, but on the back of good volumes yesterday, the stock was up. So for positional targets of 2650 and 2775, you could look at a long trade on this one. Stop loss comes in at 2400. On the short side, you've got Ramco Cements. The stock broke below the 200-day moving average 2 days ago. Continues to reel under pressure on the back of strong volume. So I think, from a near-term perspective, 814 and 805 are your targets. 835 is where you place your stop loss.
Right. Chandan, very quickly, what are your top trades? Do you have any? It's okay not to.
Yeah, so two trade on both the side, one on the sell and one on the buy side. Buy side, I'll focus on ICICI Bank. The stock is bottomed out and comparatively holding well with a consolidation breakout of last 14-15 days. So with support of 1240, we are expecting a move towards 1320 in ICICI Bank. UPL is sell call from our side. The sector is comparatively underperforming and witnessing sustained selling. And the stock has been making lower top, lower bottom formation. We have seen huge build-up of short position. The stock has been pulling down from 630 to 530 and more weakness could continue. So with hurdle of 545, one can sell UPL and it can dip down towards 500 marks.
One buy, sell UPL. That's the call coming from Chandan. Mayuresh, do we go in for a break? Okay, we'll just do a quick check on the implied as well. It's indicating to a flat start, so not too much expected in terms of market action. But Mayuresh, while there are opportunities, stock-specific opportunities, have you spotted anything? While the Nifty is down 7%, there are stocks that have halved from the recent highs.
Also, I think one stock that comes to our radar, which is being put on our list, is Swaraj Engines. I think good set of numbers as far as the second quarter and the first half is concerned. Top line growth was very decent. In fact, if you look at the volumes that they've probably sold, close to 47,000 odd units in quarter two, compared to around 38,000 units. For the first half, they have done 88,000 units compared to 78,000 units. The management sounds very, very confident because of what we've probably seen in terms of monsoons. And this trend might very well continue in terms of tractor sales going forward as well. So I think decent balance sheet, Rogan's balance sheet, volume growth has been decent, would continue probably in the next few quarters. This is one stock that we're keeping on our watches.
Okay. Watch out for Swaraj Engines as something that Mayuresh is keeping on his radar. Take a break. On the other side of the break, some specific stories, including one on IDBI Bank. Stay tuned.
Welcome back. You're watching NDTV Profit. It's not looking good on the implied Nifty, but these are just early ticks, so we shouldn't be too disappointed with what we are seeing on the screen just yet. We'll come back to this. There'll be lots of stock-specific reaction that'll be interesting to track this morning. Stocks like Bajaj Finance, Zomato, Gujarat Fluoro, 197 Communication are some of the counters that will see a good reaction in trade. Zomato up about 1% post its earnings reporting. Paytm, look at that, 11% up move as the regulator now allows them to add new UPI customers. Bajaj Finance is well higher by 2%. Gujarat Fluoro, that's the big one to track this morning on back of the fundraising plans, the EV vertical. The subsidiary, of course, being valued close to 25,000 crores is what could be a big positive. For now, muted in that trade. But let's move on very quickly. We'll come back and track pre-open trade and talk to our guest. But on to NDTV Profit exclusive. The IDBI stake sale proceeds is gaining pace with the government to call financial bids by the last quarter of FY25. My colleague Shrimi filed this report. Listen in.
Much awaited IDBI bank stake sale seems to have gained pace. As what we are picking up from our sources is that, government is going to call for financial bid in this financial year itself. In fact, in the fourth quarter is what they anticipated. In fact, they are going to give the virtual access of data to all the potential bidders by November itself. And then they are going to have a draft share purchase agreement where the RBI and the other regulatory approval will be, assessed by these bidders. Remember, the expression of interest was invited in January 2023, where all these candidates have expressed their interest towards this stake sale and the disinvestment part. And now the potential candidate have also gone for the fit and proper criteria, which they now secured it. 4 to 5 candidates are what we are picking up from our sources has secured that fit and proper criteria. And then now they are moving towards the financial bids side of it, and we will soon get some sense that whether this the entire stake sale process will be moved to the next financial year, because after financial bid also it will take 6 to 8 months of timeline to conclude the deal. So we are tracking the story and we'll get more details on that.
All right, IDBI, and that's certainly an important one. And financials are the important ones today, more importantly. So keep that in mind. Niraj, any quick thoughts? IDBI or a Bajaj Finance or M&M Finance?
No, so within NBFCs, Niraj, my own sense is that there will be a gradual recovery, specifically on the rural part of the business. Because as the Kharif season is unfolding, as realizations become better, you've already seen one round of MSP increases happen. And the expectations of a good Rabi harvest and output will probably mean that the second half will be relatively better for rural discretionary spending. And therefore, I think a few of these rural-focused NBFCs might actually start delivering in terms of both the growth numbers in advances, stability in asset quality, and therefore better numbers in terms of return ratios as well. I think a few of these rural-focused stocks, something like a Chola investment, is something that I will keep on my radar. Within the banks, within the mid-cap universe, I think Karur has given a good set of numbers. As a disclaimer, we continue to take that in other reviews. And a few of the other PSU banks as well. Bank of Baroda as an example, and Bank of Baroda.
Okay. That's financials. Now, amongst the other stocks, and we should pull up Amber Enterprises to just see if there are initial reactions. It's only 4 minutes. But remember, it's a very volatile stock. Now was up day before, down yesterday. It's now clocked in with the Q2 numbers, 82% uptick in revenues, margins stable, and has turned profitable, if you will, on a YOY basis versus a loss. Puneet Johnson to tell us about this and what to expect from other companies. Puneet, 90 seconds, Amber plus others.
Well, definitely, for Amber specifically, a very big beat because revenues were expected to grow by about 41% and they've come in at an 81% growth compared to the same time last year. When EBITDA margins were expected to grow about 40%, they've also come in at roughly 97% growth compared to last year. That's another beat. And profitability, as you rightly said, coming in at 20 crores versus expectation of just about a couple of crores of profit. So it's a beat on all fronts, and that's driven by the consumer as well as the electronic business of the company. The electronics has the PCBA assembly business, which is catering into products of these. So that's one of the key things, and that's where the beat is coming. On margins as well, it's seen a 160 basis point improvement in the consumer business, while the electronic business has seen a 250 basis point improvement. The railway business has been subdued because of lower ordering of the Vande Bharat, and they're expecting the second half to be much more profitable in this particular entity. For the EMS space as a whole, Dixon and Keynes are the two companies that are expected to show strong growth. Dixon is expected to show 84% revenue growth compared to the same time last year, while margins will be stable at around the 3.8 to 3.9%, while its profits are also expected to grow 80% compared to last year. On Keynes Technologies, again a 65% beat in revenue according to Bloomberg, while its profits are also expected to grow 88%, showing strong operating leverage for the company. And finally, Sirma, I want to just highlight because they're expected to report results this Friday, expecting a 40% growth in revenues, but margins are going to contract by 90 basis points, and in the first quarter as well, we saw 400 basis point reduction in margins because of the higher concentration of the consumer vertical. So overall, EMS players are expected to report really strong revenue growth, some more than others, and we can see that in Amber numbers as well. Back to you.
Well, that's all the action in the EMS space that we're tracking. Amber is going to be one stock you want to track early this morning. Well, a quick check of how implied Nifty is looking, and then we'll move on to quickly talking about stocks with our guest. That's it. Negative starts, up 24,400 is what we're likely to get started at this morning, but the selling should abate over the course of the day. That's really what we believe in. But of course, the handover globally as well has been not much to write home about just yet. But you've had a whole lot of earnings that the markets would positively react to. Chandan, very quickly, two stocks, Amber and Zomato. How do you read into them? What are the charts indicating on both those counters? Chandan, you're on mute.
Yeah, so looking at these two names, Amber, the major trend is positive, but on last trading session, we have seen a volatile swings in the counter. I believe buy on decline could continue because support could be there. So I believe with support of 56.20, one can look for an upside target towards 6,000 to 61.50 marks in Amber. Talking about Zomato, major trend has turned slightly negative. It can decline, and I believe a decline near 240 may provide a buying opportunity. Amber one can buy because already corrected from higher levels. Zomato, we need more corrective move to get for bargain hunting in the counter.
Okay. As the first 8 minutes are settling down, you also keep an eye out for, like we said, Bajaj Finance. You keep an eye out for Amber Enterprises. You keep an eye out for M&M Financial.
Looking bad,
Zomato.
7%.
Yeah, so M&M Financial, relatively a bit of a miss out there relative to the high expectations that were there, and which is why this dip that has come in. Kush, any thoughts here on M&M Financial on the charts?
Well, not really as encouraging. I mean, the numbers obviously have one story to tell, but the stock itself was trading below the 200-day moving average for the last 8-10 odd sessions, and the 290 mark was acting as a resistance. I wouldn't be the first one to jump and buy even at this decline, because the support zone of 265 is taken out, and the next one really comes in at 250. So you might want to hold up on that purchase even on this decline.
Okay, and just keep in mind three stocks before I go to Harsh on Aditya Birla Real Estate. Electra Green Tech, revenues up 70%, net profit expanded. Let's see how that stock is settling up, 4.5% higher. Indus Towers is the other one, strong margin and PAT performance, and Indus Tower 4% higher. GMDC, revenues up 54%, PAT up 71%. Really strong show, that's up 3% as well. We are seeing evidence starkly different from yesterday. Earning beats are getting rewarded. Yesterday was a day of earning misses getting really punished. Okay, Aditya Birla Real Estate pre-sales numbers look very strong. Nomura has come out with a note. Harsh Johnson for that big brokerage call of the morning. Harsh, good morning.
Hi, good morning, Niraj. Yeah, so extremely strong numbers, of course, as you iterated. What Nomura seems to suggest is Q2 pre-sales came in at 1,400 crore. You saw H1 pre-sales come in roughly 1,700 crore. Now, the guidance from the management is 7,000 to 8,000 crore of pre-sales, FY25 full year. How do they get there? 6,000 crore of pre-sales essentially required in H2, roughly. Nomura believes that's completely doable given the kind of pipeline that Aditya Birla Real Estate has, of course, along with a stronger balance sheet. They also are expecting operational cash flow positivity by end of FY25, and a margin of around 29% on the real estate business. In terms of the pulp and paper business, because that also is some part of the business here, subdued demand is what they're anticipating. Also, rising input cost pressure will kind of put a lid with regard to margin. 7% margin is what they are anticipating on this one. Why are they bullish? They believe long-term visibility in terms of new projects as well as launches. Second, large scale and disciplined in terms of their quality of accepting projects, and strong business development. These are some of the reasons why they believe it's a constructive buy. Stock trading at roughly 13 times residential EV to EBITDA, which is slightly higher than Godrej Properties, but very, very constructive. 35% upside on this one.
Right. Thanks for that, Harsh. That's Aditya Birla Real Estate stock you want to watch. Nomura's thoughts on that one. There are lots of stocks reacting. While Niraj, of course, wants to look at the glasses half full, he's telling you all about the counters that are getting rewarded. There are some that are also getting beaten down. So Chennai Petroleum down 10%. Numbers were disappointing. The sector is under some pain. The stock is reacting badly. M&M Finance down 7%. ICICI Pru down 4%. Cochin Shipyard continues its downward journey, down 4%. Quick check on Shoppers Stop. They reported numbers as well that disappointed the street. Welspun Corp 2%. Numbers weren't too impressive. The stock is going to be seeing some pressure this morning, down about 2%. And also a quick look on how Shoppers Stop is trading in early trade this morning. You have a couple of other ones that will be Shoppers Stop down 7%. So that's kind of painful. But Chandan, yesterday the only bank or one of the few stocks, one of the two stocks that was in positive territory on the Nifty was ICICI Bank. Today, if you have to trade banks, would you trade specific banks? And if yes, which bank are you buying?
Yeah, so already I've given the recommendation on ICICI Bank because they're the only counter which is finding some support at lower levels, and we believe that declines could be bought and major support already placed at 1220 level. So I'll go with ICICI Bank. I'll buy on a small dip with support of 1240 for an upside target towards 1300 to 1320. And apart from ICICI Bank, I think for other banks we need to wait and watch for right level to get an entry.
What about, Chandan, very quickly, what about Ambuja? What did you do with the stock yesterday? Because the news flow was very positive. The stock obviously was trading higher until there was blanket selling in the market. This morning, do you think Ambuja could be a good stock to trade on? Because some of the cement stocks should be getting a little bit of relief is what we'd expect fundamentally at least.
But technically speaking, the stock has been making lower top, lower bottom. However, it has gone to the oversold territory, but not getting any sign of the reversal as of now. So I'll wait for a conditional trade setup. If it moves above 575, then only I'll attempt for bargain hunting or contra trade to go for buy stance in the counter.
Mayuresh, what did you make of the deal? Ambuja acquiring Orient Cement. This is the third in a row. On the valuations, on the pricing. I think long-term, structurally, it's a great story. But between now and then, what's the view?
I think it would remain constructive because I think the deal has come at a very attractive price at $114 per MT. Obviously, out of the 8.5, 8.1 MT is absolutely operational. What they also get is access to the limestone mines, which probably can cater to further 6 MT in terms of incremental cement demand if they choose to do that. At the same time, the expectations in terms of ramping up the overall synergies as far as their pan-India presence is concerned, and expectations in terms of taking their EBITDA per ton beyond 1,500 odd rupees. I think that can be a plausible presumption to make because the expectation in terms of the industry construct as a whole, a lot of consolidation happening, and therefore pricing should remain constant. Even if input costs go a tad bit higher, they will get passed through because demand remains and would remain extremely strong. So I think it's a win-win for both the players. Ambuja specifically, I think earnings should respond meaningfully with this acquisition in the next few quarters.
Okay. 38 seconds left for the markets to kickstart trade, and just quickly mark some stocks that you should keep on your eye. Remember, this is the profit watch list. Paytm, Bernstein and MK have constructive because of the development. Amber, Q2 results beat on all fronts. Adani Green, good capacity additions and decent numbers. NMDC iron ore price hike. Zomato brokerage is positive as well. So a few stocks that you should keep in mind. as also Indus Towers and Gujarat Fluoro. Keep all of these in mind as the markets start trade. On the negative side, maybe, or not negative really, but may see a bit of a hit. Bajaj Finance and M&M Finance, which has certainly seen a bit of a hit. Here's how the markets are starting off this Wednesday morning. Well, a bit of a downward bias. Banks are flat, but it's actually a flat start. Nifty IT could come up on your screen because IT, the mid-sized companies have given good numbers. No wonder Nifty IT is up about 0.5%. Bring up the mid-cap and the small-cap indices. They were clobbered yesterday. For now, a bit of a relief that portfolios are not getting wonked on open. Let's get the heat map up on the screen and see what the large caps are doing. A lot of red though, very little green. Seems like some heavyweights are doing okay. Bajaj Finance, the commentary about credit costs peaking and the brokerage view is leading the stock to do what it has done, 3% higher. Bajaj Finserv following suit. Tech Mahindra, Apollo Hospitals, Bajaj Auto are amongst the others. And then some strength by large cap IT like Infi and Wipro giving that support. Adani Enterprises up 0.5% as well. The quantum of green increasing slowly. What is not doing well? M&M, another 1.5% lower. Power Grid, iShare, Bharat Electronics. It's not an all-out auto sale, but certainly M&M, iShare and Maruti pull up the list of the losers. HUL ahead of the numbers is in the red as well. Reliance is in the red. But Bajaj Finance is marching away 4% higher now on the commentary around credit costs peaking. Samina, this one is the standout mover on the back of the brokerage calls.
Good to see. In fact, all the three Bajaj Group stocks are looking really good this morning. We'll check out what is happening in the rest of the market. It's subdued. Of the Nifty 500, 0.3% cut is what we already have this morning. The hope is that the selling abates at some stage and you consolidate after the recent fall of 5% we've seen over the last 2 days. Sectorally as well, the picture is not much to talk about. Nifty IT is marginally higher. Metals after a fall of 3% yesterday is up about 0.3%. Finance is looking okay. The rest of the universe still looking weak. Real estate continues its fall. So does auto, so does consumer durables, so does everything else from the look of it. A quick check before I go into the stock movers. I want to do a check of how the Hyundai IPO is doing this morning. It fell 7% as it launched on the exchanges yesterday. We did think that there would be some buying on that counter as well, and look for retail participants who will be looking to add this to their long-term portfolio. But that didn't happen, and this morning, settling is what we have at 1822 on the Hyundai IPO. A whole lot of earnings, a whole lot of reactions on the Nifty 500. Remember, the Nifty 500 is still trading with a cut of 0.3%, but you have a few reactions. Electra Green Tech numbers were very, very solid. The stock has been resilient in the recent fall, is trading with a gain of 5%. Zomato in pre-open was expected to see a gap up, but we did believe that with the aggressive fundraise plan that they've played out, this is not positive shareholders, and hence the counter is seeing a cut of 3.5%. So that's what you have on Electra positive, Zomato negative. Indus Towers, you'd imagine the reaction would be far better and bigger on the fact that their numbers were extremely good. Operational performance is worth taking a note of. Approval has come in where Bharti will acquire or increase their stake to 50.005, but the stock trading flat on that. Coforge numbers rolled out this morning, much before the markets opened up, and the markets like what they see. The counter is seeing a gain of 6%. GMDC reported good earnings. The stock is up 4%. Supreme Industries, I'm not sure why what is happening. Management commentary was very strong, but the stock is seeing a 5% cut. In pre-open trade, this was expected to see a big gap up, but contrary to a big gap up, it's got a big gap down from what we are looking at. Chennai Petroleum reported numbers, huge disappointment. The numbers were weak, expectations are running low, but the counter still gets beaten down 10% is what we have. M&M Financial reported numbers below street expectation, counter is down 6%. ICICI Prudential, same story, numbers weren't too impressive, the counter sees a flat reaction. Paytm, they've got an approval to go out and acquire new UPI customers, on back of which the stock sees a big gain of 4%. I'm going to do a quick check on Gujarat Fluoro. Niraj just highlighted how this deal where they managed to get some funds or do a fundraising plans for their EV vertical should be viewed as a positive. I don't know why the market is not seeing that through. It's down 5% in early trade. RITES has won an order of 500 odd crores. The stock is not responding to that. A quick check on RailTel. Order win, stock is marginally higher. Sonata Software signed a multi-year AI deal. On back of which you're getting a marginally higher reaction this morning, 1% higher. Niraj, as much as I'd like to believe that we are rewarding good news, we're not rewarding all the good news we're getting. That's my limited point here. I know the Bajaj group is looking good, but look at the broader markets. I mean, look at a Gujarat Fluorochem case in point. Look at a RailTel. These are stocks that respond very sharply to any sort of positive news flow, but that's not happening yet.
I wonder if it's a sell on news for Gujarat Fluoro because the news is constructive, Samina. But yeah, maybe you're right. And important to notice, it's not a one-way street. Shouldn't be as well. The texture of the market very different. But let's get in opening thoughts. Chandan, before we thank you, what is the one thing you're watching out for? If a bounce comes in, is it a dead cat bounce which you sell into, or you will see the texture and then decide?
So I think I need to see the texture because the index is continuously making lower top, lower bottom. I'll closely watch 24,600 zone. If market manages to move above the same, then I'll change the stance. But yes, selective IT and auto will be the name where I can go for bargain buying. Even counter like Persistent System, Coforge, or name like ICICI Bank where I'm closely watching. Or Dixon is one name. If market has to move, this stock will give first signal because overall having the strength. So this is what I need to play for the day.
Chandan, I know we talked about Amber just before markets open. The stock is up 8%. And Max Financial, I think the street has liked what they've seen with their earnings. The stock is up 6%. Also, interestingly, 197 started off flat, but now up 6%. So 3 stocks for you. Kush, you want to comment on that one actually? Intraday trades on any of these because they are picking up steam as we in the last 5-6 minutes itself.
So I think Amber is one stock that you can still look at. There has been a quick sharp rebound on some of these names, but around that 6,200 mark there is some sort of resistance that comes in. So if you do have it, not a bad idea to book partially and then hold the rest for targets of 6,400. So Amber is perhaps one stock that you want to consider, from a near to a medium term perspective as well.
Chandan, you want to give us a quick update on Amber because you did talk about it before we went to market opening. And just to add to that list, Canfin Homes, good numbers, stock is up 4%. NMDC and GMDC both are looking good as we see it. Any trading opportunity here, Chandan?
Yeah, positive on the Amber. As I was looking for target to 6,200 already, it rallied well. I believe further momentum could continue. One can keep the support near 59.50 and this time it can head to 6,500 marks. Talking about GMDC, NMDC, buying interest is visible after the weakness of last couple of days. I'll go with buying of NMDC with support of 216. It can head to 234 kind of level.
Right. Well, that's the view on GMDC and NMDC. Anything else, Chandan, that you've spotted in the first 5 minutes that's looking constructive to you?
Yeah, I mentioned that I'll focus on selective IT name, whether I talk about the Coforge, Persistent System or Dixon. I believe Nifty IT will be the first to get the stability. Dixon I can talk about. One can buy with support of 14,900 and Dixon has all potential to rally towards 15,600 to 16,000 to head towards the new lifetime high territory.
Okay. Sorry. So Coforge, Dixon Tech, he's constructive there. The numbers are expected to be solid for Dixon. Remember that. And Persistent I should bring up as well because that came out with a very good set of numbers too. Persistent, 5% higher. Expensive stock, up 5%. Mayuresh Joshi, Coforge, Persistent, showing that in a sector which is clouded and if valuations are expensive, but if you're delivering numbers, the street is rewarding. The question is, would you buy them at these levels or are they very, very expensive now? Coforge and Persistent.
So Niraj, obviously, I think from a valuation perspective, they are expensive at this juncture. But again, I think if you probably look at the construct, there is a very interesting slide that I found in Emphasis presentation. They're saying that tech is disrupting tech. And therefore, I think all our IT outsourcing companies are coming out with innovative solutions when it probably comes to cloud computing, AI, generative AI. And therefore, I think the kind of tech solutions that these guys are coming out with, both in terms of products as well as platforms, are going to be game changers for a lot of companies and industries across the globe. And therefore, I think the entire take that probably comes through when you read through the management calls and management transcripts as well is that there is sufficient amount of headroom in terms of order wins from respective sectors. These orders will come at a decent price, which means pricing should not be an issue. With more orders coming their way and all these companies executing well, the earnings trajectory should probably be on a very, very steady footing in terms of both constant currency and dollar revenue growth, with very, very stable margins as well. Which brings us to the point that expensive can become more expensive as earnings keep on getting delivered by these companies. A little bit of a catch-22 situation here. I think the valuation is expensive, late-stage basis as we see it at markets with India. But anybody holding these stocks should continue holding. As a very clear disclaimer, Niraj, persistent forge emphasis is something that we continue holding enough to live.
Kush, just before we went into market opening, you wanted to share with us a little bit of a write-up on the Nifty and Man Nifty that you put together. You want to tell us a little bit more about it and where do you see this trend? Because this is a tough market. I think the number of traders making money, anyway, the ratio was fairly low as compared to the regulator. I don't even want to know what it looks like right now.
No, actually the whole thought stemmed from something that Niraj mentioned yesterday during the closing show, which is the social media buzz is that, why aren't there as many short calls, at least on the Nifty, right? I mean, stocks is a different story. I think the reason more than tactical or technical is actually more behavioral, which is the recency bias. For the last 4 years, if you see, the money has not really been made on the short side. Even if we had dips, they were swift, short-lived, and then the recoveries were equally sharp. So, giving a short call on Nifty became a bit of a tricky situation, and hence, most of the calls were either on the long side or wait and watch kind of a setup. But, clubbed with that, the Nifty RSI, and if you recall, we've spoken about this a few times, which is the Nifty monthly RSI was near 83, which is close to the all-time high, seriously overbought territories. And now we are seeing a bit of a dip, in that, which is close to 72 levels. The support comes in at 67, which means that, there is perhaps some more downside left in the markets. Now, while there is most certainly, pain in the portfolios, I think a lot of people expected this and are perhaps even considering this as healthy. So it's not a bad idea to start nibbling into stocks and sectors, maybe, start with financials and, select chemical names where you were waiting for that dip to come in. And look, you will never perhaps be able to get, the bottom of the market or the bottom prices of the stocks. But when you are seeing this dip and, the index off 7%, from its highs, is perhaps a good time to start entering into some of these names. And the limited point is that, the downturn may not be over yet, but perhaps we are close to a point where you could start, nibbling into some of these names. And, while there is some recovery, on the cards in the name of short covering, stocks will perhaps start to consolidate from here on rather than see, a much bigger dent.
Mm-hmm. Consolidate instead of a dent. It may not help you make money, though, viewers, remember that. And the key is, if it consolidates, are there pockets to bet on? So Mayuresh spoke about he's keeping on his radar to buy. So watch out for that one. Mayuresh, maybe at a short time then, but for the viewers who tuned in right now, maybe it's a repeat. But why Swaraj Engines? And are you nibbling it at the current levels, or are you biding your time because of the market situation?
So we are biding our time. So we are keeping that on our watch list. And the rationale behind the why Swaraj Engines, I think expectations of tractor sales are expected to be pretty decent as we head into not just the next few quarters, in fact, the next few couple of years as well. The expectations in terms of the portfolio that they've got is between 22 horsepower to 65 horsepower. And typically what you've seen in the Indian ecosystem is that anything below 50 horsepower works wonderfully well because of the land sizes that we've got. A large part of the farmer community has land sizes of less than a hectare, which means less than 50 horsepower tractors are a very, very lucrative choice. Second element, obviously, is the volumes that they've probably done. They've done decent volumes in the second quarter. They've done decent volumes in the first half at 88,000 odd units compared to 78,000 units same period last year. And that brings us to a fair bit of an estimate that as the second half unfolds, volume growth will remain extremely strong. What they've reported as an annualized EPS in FY24 at around 113, 115 odd rupees, they've already done 75, 80 odd rupees for the first half. So even if they replicate this performance, the earnings growth, what we map in Market India through our EPS weighting parameters, should be significantly higher. and that gives a good amount of estimates that the next year should also probably unfold to be a little bit better when it probably comes to this part of the segment. So I think earnings trajectory, balance sheet growth, expectations in terms of return ratios improving. I think all these parameters might actually play out in the case of Swaraj.
News is the Nifty has turned positive, 24,500. That would be a little bit of a relief for traders on the street that probably initiated fresh longs at closing yesterday. So 42 points higher is what we have. Okay, now it's gone back below 24,500, but still attempting to do a little bit of a recovery. A quick check on how the VIX is doing. There was a spike on the VIX yesterday as well. This morning, VIX continues to rise, 2.8% higher on the India VIX. A check on the broader market, mid-cap and small-cap index too. I would imagine the recovery should be coming there too, because they did lead the fall in yesterday's trade. Mid and small trading flat. The Nifty still doing slightly better than the broader markets in trade. The breadth of the markets improved. There are a few stocks that continue to trade under pressure on the Nifty 50, but I think that the Bajaj trio is doing a good job of keeping the Nifty up and about. Bajaj Finance up 3%, FinServ up 2%, Bajaj Auto up 1.5%, and Adani Enterprise carrying its weight as the second largest gain on the Nifty 50, up about 1.5%. Metal counters aren't doing too badly. Some of your other names in the banking space are picking up some interest. On the sell side, Shriram Finance, M&M, ONGC, Asian Paints, HUL is looking a little soft ahead of numbers. Tech is taking a little bit of a breather. At least that's what we have this morning. But all in all, as expected, there is some sort of a semblance coming into play as we see it now. Whether this holds or whether this still is a sell any sort of uptake, and if that is the ideology that traders are working with, then I don't think these gains also may sustain through the course of the day. But from what we see, I don't think it's looking too bad just yet. Relative. It's all relative right now, and we're going with that.
Yeah. Not looking bad at all. GMDC is up 5% as well. But a quick view here, Mayuresh. IFL Securities, and we'll make this quick. IFL Securities is down 3.5%. This is my last question, really. But capital market plays have delivered a very solid quarter. Mayuresh, quick 60 seconds. Are you a buyer into capital market companies?
So asset management, yes, on declines, Niraj, because I think the show has been solid. The expectations largely, at least being built in and baked in right now, are that SIPs will continue flowing in to these asset management players. And as India evolves over the next few years, what we've probably seen in terms of these asset managers, if you go through the presentations of most of the wealth managers as well, Anandarati Wealth, you've got IFL Wealth as well, which is 360 WAM. I think if you look at the pyramid and the trajectory in terms of the Indian households that can actually move up the value chain in terms of discretionary incomes over the next few years, I think there is a huge scope in terms of professional wealth managers actually doing well over the next few years. I think asset management as a space is something that we continue.
Both of you, thank you so much for taking the time out and being with us. Really appreciate your time this morning. Okay, so that's the view from our experts for the morning. But small caps under a bit of a cloud. Today might be a respite. Is this the end of the pain? Is it possible to even say that? Manish Sontalia, Chief Investment Officer at MK Investment Managers, joins us right now on the show. And Manish has attended a clutch of investor conferences in the recent past. He's spoken to a clutch of companies which are mid-sized and small-sized. And Manish, my question to you is this the dip that somebody like you might have been waiting to get stocks at better prices? Or can this dip get better for somebody who wants to buy?
So Niraj, 7% correction on the Nifty has created a lot of heartburn, but as we all know, markets don't just move one way. They go through ups and downs. I think, again, like many other dips, this is another buy on dips sort of a situation. Because I genuinely don't believe that if India is to grow at 7% in FY25 and 6.5% in FY26, that is what the IMF reiterated. And we are actually looking at earnings, of around 1,100 in FY25 and around 1,250 in FY26. How can markets really peak at 1920p? I mean, that's not done. What is the problem? The problem is that a lot of FI have taken out a lot of money. There's some sort of a liquidity squeeze because a bunching up of IPOs. Yesterday was one such IPO which actually listed at a discount. You'll have a few others like this. A lot of QIPs not getting through. A lot of IPOs coming at a discount. Some sort of a madness in this whole liquidity scramble, where everybody is just looking to shore up some of the capital because the markets have been very euphoric. I think some cooling down on this either the FI front in terms of selling or the IPOs getting pushed out will again bring back sanity in the market. I think there's a lot of value in the markets, but as we all say, that India's market has become very broad. Now we have 57 sectors to deal with. We can't just say that Indian markets are overvalued and everything is overvalued, or Indian markets are undervalued and everything is undervalued. There'll be a lot of rotation that will happen, but particularly in mid and small caps, it's not a sectoral call. It is about the individual companies. But I would believe that this dip again should be bought into. India has a long way to go in terms of market cap creation. Many years out, in the medium to long term, there's still money to be made.
Hi, it's also Samina joining in. Completely agree. I mean, I think we're all in a consensus view where the long-term story is that India is in a structural bull run. So any opportunity or weakness should be bought into. But what I want to understand from you is from early this year, we've been complaining about how FIs have been dumping India. Now, of course, up until now, the concern was valuations. Now we're justifying it, saying that China has become the giant we need to again start looking out for. But retail participation has supported the market at every dip. Even today, DIs are buying. What do you think is going on? Because if DIs are continuing to buy, FIs have always sold, then where is this pressure coming from? And if DIs are selling, what are they doing with the cash is what I want to know, because most were sitting on piles of some dry powder to allocate when the opportunity arises. So I'm just confused of what is going on operationally in this market.
So a few things out here. Obviously, FIs have been selling for quite some time, and new money into Indian markets, roughly speaking, closer to around 10,000 crores of continued SIP plus lump sum new money coming into the Indian markets. Every month you get a fresh inflow of 25,000 crores. Mutual funds have been sitting on closer to 2 lakh crores of cash. I mean, that's perfectly fine, and Indian markets were going good. Liquidity was tight. That was the stance maintained by the Central Bank of India, which is basically RBI. But now liquidity has also started easing at the margin. What is suddenly changed is this $10 billion worth of IPOs. And it's not to say that this will not get normalized, but suddenly everything is coming together. First of all, we are in the middle of the earnings season. Numbers that have come out so far have not been that great. Secondly, 1 lakh crores plus of selling that has already been done by the FIs in this month. So 17, 18 days of this month, there's a lot of selling. Plus, you had mega issues that were coming out with IPOs and still coming out this month. You had a Hyundai, you had a Vari, you have Afcons, and a plethora of them lined up, totaling $10 billion. On top of that, you have announcements of QIP by Zomato, XYZ. So I think this is the main problem. It is not about retail investors not looking to buy or retail investors actually panicking. None of that. It's just that too much of outflows have got bunched up together at the same point in time, and that is what is causing a bit of a flutter, and given that rate cuts in the US is also not a given. We all believe that emerging markets will see, increased bouts of flows because China has a problem, so India will be a beneficiary, and because rate cuts will continue in the US, India will stand to gain in terms of flows, but then none of that. Economic data in the US is very, very strong. So really don't know whether this 50 basis point cut out there is going to get followed with another rate cut soon. I mean, we can't assume that. And in India, obviously, rate cuts will happen only in the first quarter of calendar 25, nothing before that. So all in all, that's the major problem. I don't see the medium-term picture getting blurred at all. And, the whole point is that if real GDP growth is between 6.5%, 7%, Prime Minister talks out at your summit in Delhi saying that, investors will make money in the medium to long term. I mean, let's believe that. And, we all have our own sectoral picks and bottom-up stock picking, but that's about it. I don't really think there's any case of major selling or panic in the markets just yet. It is just an ordinary correction within the overall scheme of things. Don't really see how another 5% or more can fall from these levels. We have already fallen 7%. So on the headline numbers, maybe we could fall another 3-4%. That's a given, but nothing more than that is what I'm.
And you're right. It really doesn't matter if you're a long-term investor. Nobody's going to remember this 5% fall or the level they entered the market at when they look back, right? But we've seen quite a bit of the earnings season, and it's been a mixed bag so far. This morning, of course, Niraj and me were discussing how the commentary of a lot of the managements post-closing yesterday seemed positive. Any sector, any stock, or any management that has stood out for you where you would be adding incremental capital to because you're genuinely impressed by their earnings and you're believing in the promise that things will get better going ahead into the second half of this year?
So, standout sectoral results coming out from capital market intermediaries. I mean, it's stunning. And I think once you have the numbers come out from CDSL and BSC and all, that would be an icing on the cake. So I think capital market platform companies, wealth management platform is AMCs, broking entities, so on and so forth, they will actually see a massive re-rating. This is one more additional sector to look at. Purely from a wealth creation point of view, it's up for re-rating. I mean, this is one which I can sense is how this whole sector is performing, whatever numbers we have seen so far. I think there are two other platforms that came out with numbers. Again, Zomato was a stunner in terms of positives, and so was the case of Paytm. Again, a lot of incremental positives to take away in both these numbers. So as I've been alluding to in the past also, platform companies are going to be the real wealth creators when it comes to the next 5 years or so in India's context. So that's one. I think technology companies have been a mixed bag. You can't really paint a whole lot of positives out here. Book to bill still remains, but execution is still a challenge. Banking, for the first time, we are actually seeing some PSU banks report NPAs in corporate accounts. We always believe that retail NPA would have seen the trough of the benign credit cycle, but corporate accounts seeing increased NPAs, and RBI has been talking about cautiousness to be maintained on the retail side, MFI, NBFC. So it's a mixed bag on the financials. Lending institutions, not so great, and again a mixed bag for your technology companies. But otherwise, it has been a soft quarter. You have a Supreme, etc., which reported numbers, not so great numbers that we have seen this result season. So,
Manish, just one question. We were talking to Supreme yesterday, and con call of Kajaria, a couple of other companies. All of them seem to suggest that elections Q1, excess rainfall Q2, hampered first half. Second half, significantly better. In fact, Supreme went on to say that they will grow 41% in H2 over H1, which is the highest in the last 3 years that they've grown. Of course, a low base of H1. My question is, are the negatives in the price, or do you believe the valuations are anyways too stretched, and therefore these corrective moves don't make this stock, attractive enough?
No, so you're right that there were elections and, there was rainfall and government's budgetary allocation didn't get spent through. The interim budget of last year didn't get spent through. And now that the elections are over, you have a new budget. Now the roadmap is very clear, and expectations are that spending in the second half is going to be much better than what the spending had been in the first half. That's a given. But I think given the state of uncertainties regarding delivery of numbers, and of course, all of this was well known, and when markets went into expectations in terms of execution from building material companies and pipe companies, they already had some muted expectations. But if the numbers have not come out, even on muted expectation, that has come out as a disappointment. I think, again, the benefit of doubt will go to the companies and the managements who allude to the fact that second half is going to be much better. But I think seeing is believing. Markets will see the numbers and then maybe re-rate the companies. I mean, of course, just an anecdote in this regard was that rural economy is going to turn and is looking much better, but we believe that nothing of that is basically coming through from the rural front as well. Some of the numbers that have come out from Nestle's or even today's HUL don't really paint a picture where rural seems to be coming back, and on top of that, you have a very inflationary environment. A reasonably good inflation sort of a situation where margins may be under pressure. So I think consumer, again, and capital goods, particularly on the government spending side, would be sort of a disappointment in the first half, all well known. And though the benefit of management, but I think markets would only see the numbers in the second half and then maybe take a call in terms of re-rate.
Right, Manish, always great talking to you. We have a good festive few weeks ahead, and we'll hopefully connect back with you in November when things settle a little bit from here on. But good seeing you. Have a good week. With that, thank you. We keep the focus on earnings. Responsive Industries reported numbers which are largely ahead of what the street was expecting. Actually, the growth that the company has seen has been pretty healthy, and the outlook is what we'd want to get a sense of. The stock is trading flat, but Atit Agarwal, promoter of Responsive Industries, now joins in. Atit, thank you very much for joining us this morning. This is an interesting company. Recently, of course, there were a couple of brokerages as well that have been very constructive on your growth going ahead. And this, of course, is backed by the fact that India's infrastructure plans seem to be on point for now. But talk to me about your earnings. Can you give me a detailed breakdown of your revenue by product line, geography, or customer segment?
So basically, the company has done very well, as you can see in the numbers in the quarter-on-quarter, year-on-year, and as well as the first half H1 FY25. The company focuses on key segments such as resilient sheet vinyl, artificial leather, SPC, LVP floors, waterproofing membranes, and the synthetic rope segments. Primarily, the resilient sheet vinyl is used in segments such as the Indian Railways, predominantly the Vande Bharat trains and other such segments. Also, we are suppliers to companies like Electra Green Tech and other companies for the bus floors. The artificial leather is also a segment that goes into these railways and bus bodybuilders. Also, the key segment that has been also a growth driver for the company has been the SPC and the LVP floors, which has shown a great market in the US, where basically the China plus one requirement has been looked at. And the customers in US have actually started looking at companies other than China for this requirement. A key point being that independent reports mention that the market for this product is about $7.5 billion in the US, and predominantly was supplied by China and Thailand and Vietnam. So the potential. Sorry.
Yes, Atit, just before we talk about the global potential, I think there's some merit in you explaining to your investors, us and our viewers, what is this PVC membrane? I understand that it goes into tunnel construction, and you have two very high-profile projects, one in Sikkim and one in Rishikesh. You want to tell me the size of these two projects? What is the contribution to the top line? And I also believe you're entering the vinyl business on the B2C side. Again, I'm a little perplexed about the various things you do, and it's obviously a big gamut of offering that your company has. So tell me, how much does PVC membrane contribute? What do these two big lines do for your top line, and the new business vertical that you've launched?
So this is one of the margin accretive products that we have launched, which is called the waterproofing membrane. This is predominantly used in tunnel waterproofing, and the projects that you mentioned should account over the next couple of years to the tune of about 50 to 75 crores to the top line. And like you mentioned that the potential is pretty huge in these segments. Also, when you mention about the B2C, what is the SPC LVP floors that we make is what we are looking at getting into, because predominantly the company has been a B2B company. And the idea is over the next 3 years to make it more towards B2C and have these products in the Indian market and launch them from B2C segments. These predominantly go in houses and retail stores. We are focusing on affordable housing, tier 2, tier 3 cities, and rental homes. The key issue being that the floors in these places you cannot replace, especially in a rental home, whereas you can replace anything else. And the idea is that these are click and lock flooring, which goes above the existing floors, and you can keep it in place till you're in the house, and then you can remove it and take it with you if you decide to change homes.
Got it.
The idea of the company, finishing on that point, was that the idea of the company is to set up about 100 stores between tier 1, tier 2, tier 3 cities over the next 3 years under the COCO and the FOFO format.
Okay. Are you the market leader currently, Atit? Good morning. Or what is your pecking order in terms of the hero product that you have?
Good morning, Niraj. Yes, we would like to say we are the market leaders.
Okay.
We are a complete vinyl flooring company where we make products from the beginning till the end and all other aspects included in the product.
Okay, fair call. Now, so I heard you mention that you want to expand now on the B2C side in India predominantly. If I'm not wrong, your export domestic mix was 60-40, 60% exports, 40% domestic at the end of FY24 at least, right? So if this happens, does it mean that your presence in the domestic market goes up over the course of the next 3 years? Part one of the question is that. Part two is that a more margin accretive business? You're currently at what, 20-odd%? Does it enhance margins for you?
So predominantly the export domestic ratio should remain same going forward, because obviously the global market in this segment is much bigger. The idea is to create category creation in this segment going forward in the next 3 years. Margins are pretty good in this segment. We are targeting at about EBITDA level of about 20 to 25% in this segment. Globally, the market margins in this is around 25 to 30%.
What's the guidance that you're giving then? Because you're talking about a very strong growth domestically, but you're saying you will maintain the mix, which means you expect the same kind of growth on the export side as well, right? So what is the guidance that you're giving? Is there an aspirational target or a realistic target for not just FY25, maybe the next 3 years?
So if you've seen historically, the company has grown at a CAGR of 20-25% over the last 2 years. The idea is to maintain that growth on the top line and on the bottom line as well over the next 3 years. The idea is in the next 5 years to see if we can double our top line.
Say double your business?
Yes, in the next 5 years.
But sorry, just one very quick follow-up there. That would mean that you will not grow at, you will probably grow at 15% instead of the 25%.
No, so the idea is that we are targeting 5 years, but the idea is to do it quicker. The order books are strong. The business looks good. The government push for the domestic markets is looking good. The government's push towards Vande Bharat and the green technology for converting the buses is also looking good. So presuming all this comes online, in the next 3 to 5 years, we should double our top line, and the bottom line should maintain with current margins.
Right. Atit, you did mention that the order book is looking quite healthy. You want to tell us what your order book stands at? And you said the government pipeline also is healthy. What percentage of your order book is coming from governments, and what does the total order book stand at? And what is the visibility of that?
So the current order book stands at about 500 crores, and the government contributes to about 15 to 20% of that. The order book is looking good in the idea that we tend to keep a 3 to 6 month order book in it.
Also, what I want to ask you is, what is, of course, your plans are ambitious and hopefully it all placed to plan. You want to tell me where capacity utilization is at? Because if you're growing at that pace, would you need to add more capacity? Where do you stand?
So current capacity utilization is at about 55%. So we are fairly placed in the current situation. Capex requirement does not seem very required right now going forward for the next few years.
Okay, Atit, you mentioned that you remain debt-free, and the intention is to remain debt-free. Would you need to raise any capital in the next 6 to 12 months to fund any of your capacity expansion or acquisition plans?
Nothing as of right now. We are very fairly placed. The books look good. The capital requirement, what we require is already there through internal accruals. So no plans as of right now to raise any debt or any of that.
No debt, no capital fundraise as well. You will fund your entire expansion as things stand via internal accruals and cash flows.
Absolutely.
Okay. Including the 100 stores that you will set up, whether it's company owned or franchisee owned.
But Niraj, that's over the next 3 years. So that's not something that's coming up. Whatever we set up.
But that expansion plan, sorry to cut you because paucity of time, but that expansion time you will fund via debt, or would you fund via equity fundraise? Just trying to understand that.
It depends. The idea is that in the next 3 years, depending how the plans go and how many FOFO stores come in and how many COCO stores come in, because like I mentioned, it's a 70-30 ratio. So we will see going forward. The capital outlay for that will not be very high.
Not be very high. Okay. Well, Atit, good plans. Wishing you all the best for that and more. Thanks so much for speaking to us today.
Thank you so much. Have a great day.
Thank you. You too. That's Responsive Industries. Fairly confident about numbers. Grown at 25%. But when asked about why is it that only doubling in the next 5 years, he was candid enough to say it could happen earlier, but they're just playing it safe. Understandable in a scenario like this.
No, and I think the numbers are phenomenal. It's a debt-free company. They've got capacity that they're sitting on. So lots of other operationally good matrices as well that we should be looking at. Our government orders are coming in quite significantly. Their domestic order book is big. So all in all, I think Responsive looks good. I think a couple of weeks ago, there was also a smaller brokerage, but a Ventura actually upped their target price by 50%. So that's Responsive for you. But a quick check on the markets. It's all looking green for a change, at least from the ticker that I'm seeing on the bottom. Nifty 50 is marginally higher this morning. We've reclaimed 24,500 for now. We'll be watching that closely. Bank Nifty also not doing too badly. Sectorally, most sectors are trading higher, barring maybe a few here and there. And the reaction to earnings is also largely positive, as we'd expected. With that, we're completely out of time. Thanks for watching. But up next, Niraj will be in conversation with the market guest on Talking Point. Parag Thakkar up next.
Thanks so much for tuning into Talking Point. I'm your host, Niraj Shah. We are essentially doing or focusing today's Talking Point on financials predominantly. We have the management of Union Bank joining in about 10-15 minutes. But before that, a very important voice who's been constructive on financials, Parag Thakkar of Santulan AIF joins in right now on the show. Parag, good having you. Thanks so much for taking the time out. How have you viewed the results of some of the financials that have come out? I want to start off with... I don't know if you, look at it individually. And by the way, none of these are recommendations from you, Parag. But trying to understand, let's start off with Bajaj Finance because that's the main big boy of the day today. And then we'll move on to some of the others. What did you think of the numbers? What did you think of the commentary more importantly?
So, first of all, as you have rightly said, this, just a disclaimer from my side that these are my personal views. And one has to take buy call based on advice of financial advisors. I'm not recommending any stocks here. One overarching point in this results will be asset quality. I think that is where market was not so much focused in last 2 to 3 years when everybody was focused on growth and margins. Asset quality will be the main driver now. Because since we have started seeing some stress in some unsecured segments as highlighted by RBI very rightly earlier. So I would say that Bajaj Finance, coming back to Bajaj Finance specifically, I think market was anticipating a higher, I would say NPAs, the higher credit cost guidance. And it came at a lower end of the credit cost guidance. And the growth rate has remained same in terms of guidance. And the stock was brutally sold and completely oversold, I would say. So for a quality franchise like Bajaj Finance, when you report a number which is better than what market anticipated, the stock is likely to react positively. And same, just to extend this thing, we saw results of Axis Bank, HDFC Bank also. Gradually, everybody will start seeing asset quality is a most important thing. It is again coming back into full action. And that is where nobody can beat HDFC Bank because the gross slippage ratio are at 1.2, 1.3% versus 1.8 to 2% for many other large banks also. So on growth, definitely ICICI Bank has more levers because their CD ratios are more comfortable. And on asset quality side, definitely HDFC Bank is undoubtedly the best. So I would say that, and I'm constructive on financials, as you rightly said, because see, their multiples are 35% cheaper than overall Nifty. So whatever earning disappointments or slow growth is priced in the stocks. And now that very rightly RBI has changed the stance from withdrawal of accommodation to neutral. So there is a surplus liquidity. So I would say the deposit problem is gradually easing, and which is very good for banks because that was a big issue up till now. So any bank which is lending prudently, which is a strong deposit franchise, ideally HDFC Bank or ICICI Bank kind of names, should do really well. And even in mid-cap and small-cap space, I would like to draw your attention that last time when we spoke, we did not speak too much about mid-caps and small-caps. But after yesterday's carnage, there are many mid-caps and small-caps which are also emerging as a value buys. Just to name a few better.
Parag, already, did you find the commentary of some of these mid-caps? Sorry, before you get into the names, did you find the commentary of some of these companies constructive, or is it that the valuations have become reasonable?
I feel valuations have become attractive because I'll tell you, from election standpoint, after election, the government spending is slow, right? Festive season is yet to see its, it is halfway through. So, and the vibes which we are getting from commentaries of various two-wheeler companies or car companies is not that great. So I would say that this is today you have to buy financials because they are undervalued, not because the commentaries are going to be great. Because definitely, as I said, and I'm expecting this from many banks which are going to report numbers, like ICICI Bank and all, that more and more focus will turn towards asset quality.
So I would say that on one hand, for example, just to give you, I was naming some housing finance companies like LIC Housing or PNB Housing and those kind of names. You see the P multiples. LIC Housing trades at 7P trailing. Now imagine a situation. They are lending to home loan buyers who are salaried. 80% of them are salaried. The tenure of the loan is 7 years, 8 years, right? So your market cap, which you are paying today, is going to come back to you in 7 years, even if they shut down the business today. Just that you have to just take a call that the housing loan borrowers don't default. And I don't think in India, macro-wise or micro-wise, it is such a bad situation that somebody will default on their house meaningfully, I would say. So PNB Housing also, there's a 17-18% growth. PE is just 10. So I would say that this is a valuation play. And remember, Niraj, in my view, you can make money in stocks from long-term perspective only when things are a little bit shaky on the ground. And so the valuations are reflecting that pessimism, which is coming in short term.
Parag, the question that comes to mind is the valuations, let's say on HDFC Bank, right, have been very constructive for a while. Yeah. So people who've bought in HDFC Bank on valuations have not really made enough money or reasonable money relative to other sectors. So why now is the question?
Yeah, so that is why now is a very good question. See, when the merger happened, right? The merger happened with the logic that 4.5 lakh crore mortgage book will come, which will have a stable 8-year maturity. So it will give them good stability in terms of earnings and the loan book AUM growth. The point which happened after the merger, like liquidity got tightened significantly as US increased interest rates by 5%. In India, there was a rate hike of 2.5%. So suddenly the liquidity dried up. And when they needed it the most, right, CD ratio went up to 110%. Now they are quickly bringing it fast back to below 100. Right now they are at exactly just close to 100%. And the management endeavor is to bring down that as fast as possible so that they can again come back to growth phase. Right. So what I think, in my view, the latest quarter result, where they raised 1,20,000 crore deposits, brought CD ratio down, asset quality remained stable, and deposits grew with good asset quality. And combined with that, valuations, I'll tell you, very simply put, FY27 EPS, in my view, is around 115. If you just give 15 times to it and add 250 to 300 rupees subsidiary value, it comes to 2,000 rupees. So from stock price perspective, also it offers good value as it is a large cap. Plus, management has done excellent steps in last 6 months. See, these are, and I love this, genuine businesses which underperform, right? So because underlying value of the business keeps increasing while market is just focused on 2-3 parameters and they just don't take care of it, right? Because market wants excitement, market wants growth. Now here in the best thing in favor of HDFC Bank is that people know that growth is going to be slow because they want to bring the CD ratio down. So if they do execute very well as they did in last quarter on deposits, asset quality and NIMs, I think we have a long way to go.
Okay. So you are buying financials despite asset quality not necessary, or despite commentary not being as solid because valuations are favorable. So that is one part of the bucket. You mentioned some thoughts around what you may find favorable, and viewers have to do their own due diligence. Beyond financials, Parag, I was looking at the results yesterday of a Kajaria Ceramics, of a Supreme Industries, of a Responsive Industries this morning. So building material related pockets, their first half has been very disappointing, but they are all guiding to a very strong second half. All of them are real estate ancillaries. The cycle still seems to be decent, even if it may be coming off slightly at the margin. How constructive or not constructive are you on some of the building material companies which are guiding to a strong second half?
I would say, see, because I don't track building material space very closely. Of course, Supreme Industries is a fantastic company, super franchise, 30% ROC track record from last 25 years. And I have huge respect for that company. The only thing is that this space, I would say that this is one of the space which might hold on, because we have seen the last 2-3 years the real estate sales have picked up. And now people will be shifting and people will be doing interiors, and so building space is a space which can pick up, which can show some resilience and some momentum. Festive season is also going on, so I think. But the problem, Niraj, with most of the sectors today, apart from financials as we speak, is valuations, right? So in many cases, which I would not like to name, in many cases the earnings are at bottom by valuation, while the stock price is at all-time high. So, and that is one of the reason I keep coming on to financials, where you feel, the stocks, just to say, as I told you, LIC Housing trailing P is 7, Federal Bank P is 10, 11. And now with Mr. Manian kind of person coming in, and of course, Shah has run it beautifully, I would say very conservatively, strong deposit franchise, and very conservative underwriting, I would say. But the only problem was the ROI was not expanding, which I would say that in Mr. Manian's term, in the next 3 to 4 years, the ROIs will expand. So I'm saying that the problem with the market was, and of course it has corrected a bit now, which is good. But I would say that most of the market was running on narrative. And that is why when Nifty hit 26,000, we raised a huge amount of cash in the portfolio, which we are deploying now. Because we felt that everything was running ahead of its time. But now that after yesterday's carnage, I am seeing a lot of value emerging in the market. But still, see, I'll tell you, in a financial company, it's a leverage company, so you give lower multiple, that I agree. Because it's a leverage business, and it's a just 1 or 2 or 3% ROA business. But the point is that there you are getting 15% growth for PE, which is less than 15, like in the case of, say, HDFC Bank or ICICI Bank. And these are very good names, right? So otherwise, in any other sector, if you go, for a 15% growth, you are paying 35, 40, 50 times, which does not actually fit into my framework.
Got it. Okay. So you are, Parag, it seems that you are largely focusing on financials because there is a good quality at a reasonable valuation opportunity available. Okay. Is there any other pocket where you find the same construct?
So I would say that IT, as we discussed last time, TCS, Wipro kind of stocks.
No, but mid-sized IT, Parag?
So banking and IT are majority of the sectors. There can be some stocks here or there in other sectors.
Parag, sorry. What I meant to ask was when I speak to persistent systems today, when you hear Coforge and their commentary and the growth, they are delivering growth already, even if they are expensive. Would you bet on that because they are delivering consistently, or would you want to bet on valuations, even if growth may or may not turn very favorable at the time horizon that you want in large cap IT?
So all credit goes to, I would say, persistent after Mr. Kalra has come and Coforge after the CEO has come. They have turned around the companies beautifully. Full marks to them. And the results were also fantastic. I saw 5% constant currency growth in such environment. And now when the Fed is at a tipping point and Fed is ready to turn dovish, they already started doing a 50 basis rate cut to save, or I would say to protect US economic growth and job market. So I would say that IT is a fantastic space. They see, on one hand, financials is a leveraged space. On the other hand, IT generates huge amount of free cash flows and so dividend yield and all that. So I would say that I have stuck to TCS, Wipro kind of names. But 100% I will agree with you that Persistent and Coforge have lived up to their expectation. In fact, they have exceeded their expectations. The only problem with me is that I cannot buy a 35, 40 kind of P multiples.
Got it.
But there is no taking away from the fact that these companies have done beautifully.
Sure. Okay. Parag, I have one last question. Coming back to financials, but non-lending financials, and I want to specifically focus on capital marketplace. almost everybody who's been in the market and has seen for so many years now says that the next 5, 7, 10 years also, the growth could be explosive. Now, do you buy this theory, and therefore, do you buy or hold any capital market related plays, brokerages, AMCs, utilities in your portfolios?
So basically, see, this is the space which is where I belong to, right?
Exactly.
So I cannot be a pessimist in that space because I belong to wealth management business. But generally, my view is that I don't see, as such, we are invested in markets, as such, we are putting money in markets. Now, to play proxies or to play the same thing is not my DNA. So because we are already there, right? Why should we over leverage ourselves for stock market and for capital markets? That is my view. I see business is like AMC, for example, and I work with ICICI too. The businesses are excellent, right? It is infinite ROC business. So business, there is no doubt on business, but at what value you buy and in what kind of cycle you buy. I think we have seen a huge amount of retail participation already in the market, and already regulators are a little bit worried about it. So I would not put my money into capital market related business now. I know this is a very, very contrarian view from others, and all the people whom I respect in the market and I have a huge respect for, they mostly are bullish on capital market related businesses. But because one fact is that they are high ROC businesses, high cash flow generating businesses like IT. But in my view, stock markets have their own cycles and they are very difficult to predict. And so after such a big euphoria of demat accounts and after such a big euphoria of new investors coming in the market post-COVID, I will not be very excited about this space.
Got it. Okay. Fair point. Parag Thakkar, such a pleasure talking to you. Thanks so much for joining in and giving us your perspective. And we continue our conversation on financials, by the way, on this talking point. Union Bank is the company in focus. The lender posted second quarter numbers and profits jumped 34%. We asked Nitesh Ranjan, Executive Director, to put these numbers into perspective and about the growth outlook. Listen in.
So for the quarter ended September 2024, Union Bank of India has reported good set of numbers, both in profitability as well as the business. And also the most of the guidance parameters, including the recovery and slippages, bank has reported in line with the guidance. So far as margin is concerned, you will recall that we had given a guidance that during the current fiscal, our NIM will be in the range of 2.8 to 3%. And in fact, for the Q2 also, our numbers have been 2.9, which is in the mid-range of that guidance. Having said that, there is still pressure on the cost of funds while a large quantum of deposits have got repriced over the last 1 year, but still the deposit rates remain elevated. Our sense is that deposit rates have perhaps peaked out, but it is going to remain elevated for quite some time, maybe around 6 months or so from now, till the time we see some action from RBI in terms of the rate cut. Okay.
All right. I just wanted to understand, you've said that your guidance is, between 2.8 to 3%. Just wanted to understand what is the rationale behind this, given that your RAM, you're saying that, you expect to, bank on RAM advances going forward, and it's a high yielding book for you. That is also seeing a bit of a slowdown on a sequential basis. So what is the rationale behind sticking to this guidance?
So if you look at the RAM book, we have been growing in the range of 12 to 15% for the past many quarters if you look at the annualized growth rate. This year in the first few months have been very lean actually. But we have started seeing the pickup from mid of August in retail as well as the MSME sector. And now being in the middle of the festive season, we feel that this trend is going to continue only. And we are seeing a good traction in terms of the new sanctions, both in retail as well as in MSME. So this should help us in achieving the guidance level.
So also wanted to understand, after the whole MTNL fiasco, Union Bank of India has actually, let go of some of the corporate loan book exposure. So just wanted your sense on that as to, going forward, what is your sense on corporate loan growth? Are you seeing some slowdown there? What is your outlook on the same?
See, 45% of our loan book is to the corporates, right? And over the last 6 months or 12 months of also, if you look at, we have seen good demand coming from few sectors within the corporate, be it road sector, iron and steel, chemicals, some of the renewables energy, data center, logistics. So there is a good demand that we are witnessing. And of the 11 to 13% the guidance that we are giving for the overall loan growth, I think corporate is going to contribute a lot. Yes, during the quarter, you might have seen there's some subdued growth in the corporate sector. That is because we have let go some of the low-yielding corporate loans opportunity in the market, because we have to ensure that we are in the guided range of NIM of 2.8 to 3%. Otherwise, there is a good opportunity in the corporate.
So going forward, which sectors are you looking at in terms of corporate loans that are attractive right now?
As I said, there is no particular preference for the sector. It depends on the opportunity, the promoter, and all these things. And I already shared some of the sectors from where we are seeing the good proposals are coming to us. As of now, we have close to around 35 to 40,000 crores of proposals under discussion for the sanction. And these are typically into the road sector, iron and steel, chemical, renewable energy, logistics, and so on.
Sir, also would like an update on on the MTNL bit. Sir, what is the recovery plan on that? If you could just provide a status on that.
I'm afraid I will not be able to speak about a particular account.
Okay, no worries, sir. I completely understand. Sir, moving forward on the MSME lending space, MSME is also witnessing some slowdown. What do you think is the reason because of that, and when can we see a revival on the same?
Yeah, as I said that in the retail, agri and MSME segment, first few months of this half year, we have seen very lean progress. But from middle of the August, there is a good traction, there is a good demand. And that's why you'll notice that even in MSME, sequential growth rate during the quarter is around 2.8%, which on an annualized basis is a good number. And as of now, we are focusing on various MSME clusters across the country. And we are hopeful that there will be good sanction and disbursement in MSME during the second half of the year.
Okay. So one thing, the slippages, your slippage ratio has touched a 2-year high, in the second quarter. Credit costs are also rising. This is also impacting asset quality. I mean, it's not just for Union Bank of India. We are seeing this trend, taking place across, the banking sector. Just wanted your sense on that. Would you say that, good asset quality numbers are kind of behind us now? And how do you see asset quality, the trend going forward from here on, given that the whole economy is witnessing a slowdown?
Yeah, first of all, you look at our guidance for the gross NPA, which is for 4%, and we are moving towards that. Continuously, we are bringing down the gross NPA quarter after quarter, and this quarter it is 4.36%. Secondly, I think from our bank data, I can tell you we are not seeing any kind of serious asset quality concern for any book in the bank. Yes, there was a large account which we had highlighted during the Q1 con call also, that is in stress, and that stress has actually materialized, and that account turned NPA. That is why the delinquency ratio, credit cost, everything looks higher for the quarter. But if you remove that one-off large account, I think delinquency as well as the credit cost are either in line with what we have reported in Q1 or in fact better than that.
Sir, I understand that unsecured retail book exposure is not as high for Union Bank of India. If you could just throw some light on what other segments, are leading to the rise in slippages?
So if you look at the numbers for Q2, even compared to the sequential basis Q1, in fact, there is decline in the new slippages in retail, agri, as well as in MSME. Only in the corporate there is increase, and as I said, that is because of the one large account. Otherwise, we are not seeing any increase in the slippages. In fact, if you remove that one large account, then the slippage for the quarter for Union Bank of India is around 1,800 crores, which even compared to Q1 is lower, which was around 2,100, and previous year itself it was a little higher. So actually, we are seeing stability at the current level of, you can say, on an average 2,000 crores of slippages per quarter.
Okay.
Welcome. You're watching the FNO show. It's still a difficult day of trade. Agam, we weren't anticipating the kind of sell-off that we saw yesterday. In fact, exactly on the show yesterday, we were of the opinion that 24,700 would hold. Most of the technical analysts we said to as well said that Nifty becomes, Bank Nifty is a buy with a 300, 400 point cut. But all those levels were taken out yesterday. The Nifty ended much lower than we would have liked. It's down 7% from its